Well, good morning, folks. How are you? Just give me a minute here or two. I'm going to place you on mute for a second. Audio check one. Okay, so we should be okay. All right. Good morning, folks. How are you? Hope everybody's doing well. Sorry for the delay. My wife is not here to help me do the wrangling of the pups, so I was giving them a little bit of peanut butter to try to hold them off as I put them in their kennel. All right, so it's going to be a casual one today, and just as a reminder, I will be here every day this week at 9:30. Give me a little bit of time up to that point. I'm aiming between 9:15, 9:25-ish in that ballpark. There's a couple things I'm juggling in my personal life this week that prevent me from doing a little bit earlier start time. But with that said, just know that we'll have a live stream. I guess the easiest way is just to kind of like head to the channel if you're gonna want to be here. Hang out around 9:15, and you'll probably see the logo for my YouTube channel. It'll turn red around the outside of it. If you click on that, it'll take you right to the live stream. I don't know how to notify you otherwise, so I said just anticipate between 9:15 and 9:25. Today, which is Monday, August 12th, through Friday. So tomorrow and on Wednesday, we have some high-impact news drivers, the PPI, CPI numbers. They're usually the ones that tear your face off, and it's real hard to predict what they're going to do. They're extremely manipulated. So just know that we'll be waiting for the market to kind of like digest that, and a good time to do that is a few minutes before the opening bell at 9:30. So I have a few things I want to cover while we're waiting for the market to meander around here a little bit more. The YouTube channel for my son, Caleb, last time I checked, it was about 12,000-ish subscribers. Thank you for that. I'm sure there's probably going to be a little bit more people following it without actually subscribing, so it is what it is. But he had to work this weekend, so that prevented us from having a session together where we could review. So I'm deferring that one, and if it becomes impossible to do that, I will simply just do a video covering and reviewing the week and how his charts should look, and then he'll have to watch it, and then we'll have to do a subsequent video where he can kind of like add his view on it. But we have 7 o'clock this morning, delineating that here. This is kind of like what you should be doing, Caleb. And then we have the run here, creating the initial buy side liquidity, and the low, taking that out here. So we have a minor sell side liquidity pool resting right below here. And you can see how we're working the initial sell side liquidity, which is that low right there. Now, whenever I have a time where, if I'm looking at a specific element of, for instance, like 7 o'clock, say it's your opening time for your trading, as we were talking about last week. If you're going to be looking at the charts and start watching prices early as 7 o'clock in the morning, you're going to be met with something like this, where you'll have a high right here to the left of your start time, and then actually right at 7 o'clock creates a high. Whenever it's like that, I'm going to wait for the initial run, because I know it's probably going to take this high out, and it's certainly probably going to, hear that? Certainly probably, I just coined something else, the short-term high is created right at the 7 o'clock candle. So that initial liquidity is an interest to me. So I want to watch and see, does it in fact trade above here? And if it does, I'll give it some allowance, okay, to trade there. I'm not trying to annotate that high. I want to see the short-term high here form and then start to trade lower. And if it takes out that low, then I'm highlighting that high and I'm highlighting that low. So now you can see we ran above this here. And if you look, scrub over here to the left a little bit more, Michael. So you have all these relative equal highs. The market did in fact make a run above that. So that disrupted all that price action over there, which leaves this low, which is a minor sell side liquidity. It's inside the range starting at 7 a.m., but it's also inside the range that was formed from the run from the London session, which is over here. Now, initially when I'm looking at this, my eye gravitates to this low, and it also gravitates to these lows here, which is why I have this low in mind, this low, and this low, which is why I have all this highlighted as a layered sell side liquidity pool. So there's a few of them in there that have my interest. This is relatively equal to that, and it's also slightly higher than that. And then we have this low here. Even though this one disrupted that, I have to at least consider that. Okay. The upside, where we had these relative equal highs, and we had this old high here, which is initial buy side, we've already ran that and started to sell off. So on the buy side of the market, it's been made jagged initially, but we have no news data ahead of CPI and PPI going into Tuesday and Wednesday's trading. So when we have that, it's kind of a little bit more uncertain, I guess the right words would be. So you have to pick your shots a little bit more carefully and kind of like analysis. I got peanut butter on the roof of my mouth too. I snuck a bite before I gave it to them. You have to do your analysis a little bit more critical than if you had a high impact or news driver that's medium impact during the morning session. And since we have nothing of that this morning, and we have some really big heavy hitters for Tuesday and Wednesday at 8:30, they're going to move around a lot. So a lot of interest is kind of deferred until after that report comes out on Tuesday and after the report comes out on Wednesday. And if you take a look at your economic calendar, you'll see what I'm talking about. It's the PPI and the CPI numbers. I don't ever care to know what those numbers are actually stating because, frankly, like I've mentioned many times before, it's of no interest to me. I'm not going to be astute enough to know what that data is going to tell me for a buy or sell. It's not giving me any kind of information that is actionable. So therefore, I never consider worrying about what the raw data is. I'm sure some of you in here listening that are very interested in the fundamental aspects of the market. And if that suits you, then well done. I just don't have an interest in that. So therefore, I defer all of that to everyone that wants to consider it useful. I look at the time when the market is likely to give those types of runs. They go protracted, usually one directional, and then sometimes they'll change on an aggressive reversal and go the other direction. Most of the time, it's just a one directional landslide, okay, or just blows up and goes straight up. And it's really, unless you're really positioned early on, something in London or whatever, which I don't try to do that. And to prove my very low interest in trying to be in a directional move for CPI or PPI, I have on Twitter Spaces in the past mentioned what I thought was going to potentially pan out and what direction it may aim for. And true to form, it's never accurate. So I shouldn't say never. I think I was right twice last year with the CPI and PPI, but otherwise I'm usually wrong. So I don't need to do that for years and years and years just to belabor the point and say, okay, well, this is not advantageous for me. So I sit on the sidelines and I wait for more information to come after that market is moving because of the intervention, because I don't know where they're going to put the market right as that report comes out, and no one really does, to be honest with you. No one knows that. And even if someone had an inkling, I'm confident that if a position was placed large enough ahead of it, they would run it the other way just for the sake of upsetting it. So that's the conspiratorial mindset of Michael, right? So I'm not interested in worrying about all those types of things. When we look at the market, it's probably better for you to trade when it's not having a day like this where there's no real data to concern ourselves with, and trade in the afternoon. But if there's things that are in the marketplace that are more conducive for taking trade setups, looking for price runs that move to a logical price level, where it's really telling, it gives you insight that I guess goes against the grain of retail stuff like supposed diagonal support and resistance or indicator crossovers or oversold, that type of thing. If I have those types of advantages in price action, and they're hinting to the likelihood of that arm wrestling match I talked about last week, where we have smart money concepts, time and price, and liquidity and inefficiencies. If that's arm wrestling, if it's arm wrestling the central tenets that go along with retail trading concepts and things that lead to, in my opinion, guessing, I guess it's more appropriate for me. I'm not saying it should be appropriate for you, but if you have an affinity for just trying to trade every morning session because that's your operating hours, if you have those types of things in play and you can identify them, you don't really need economic calendar to, I guess, push a narrative or push a sentiment. You can just trade just the price action itself. You don't need a whole lot to go on. But it's in my interest as an educator to kind of like promote the idea that an economic calendar behind you, moving with the ideas that you're looking for technically, that in my opinion is better. So when you have a morning without economic data, it becomes a whole lot more problematic in terms of seeing sustained price runs. You have to know what you're looking for, where you're looking to take profits, partials, move quickly to protect your position, not try to look for home runs. Give yourself flexibility, knowing that you potentially may get it wrong because you have big news on the following day and day after. And in this case, we have that with PPI and CPI. So it's important to pay yourself if you get the opportunity to do so. Give yourself the opportunity to see if it can run, but don't punish yourself if it doesn't. Case in point right here. Partials always pay. You never have to worry about being right or wrong once you take your first partial. It completely removes all of that necessity about being right or wrong. So let me cancel this order because it should have given it to me. In my opinion, it should have went down there, but it didn't. So because it came back, I have to sit and relax and give some more time to the marketplace. We have the opening range still here. I think we'll still come down in here, even though it took me out before it actually did it. But this would have been a transaction that would not take away from the equity. It added to. When we have opportunities to see the price action move in our favor, and we don't take partials, if we do not take a piece of the pie, if you will, or a bite or a pound of flesh before it gets to our major objective or our terminus, our main target. If that's not the case for your trading right now, you need to start adopting that, because especially with the volatility that's in the markets today, I'm not saying specifically today, but in recent months and years, that volatility is going to give you a whole lot more adversity. The markets could come back multiple times into the general vicinity where you entered the trade at. And when you have the potential for the market to pull that deeply back into your trade, if you don't know what you're looking for, if you're afraid to get back in, or you just lose the plot, you have no idea what it's doing, it's better just to take that victory, whatever that was. In this case, you see a limit order was filled, you see that a stop loss was brought down to protect the underlying position, and it came back just to take it, and now we're back inside the range created from that run here to that short-term high, and we have yet still to take out. Let me take these little identifiers off for a second so you can see. Just fell short of running into that. Okay, now these are the little gremlins. Okay, the little gremlins that creep in to your trading, and you can get emotional about it, you can get mad about it, you can punch the air and say it's so-and-so's fault, it's somebody else's fault, or you can say, you know what, I was part of a move, I looked for certain signatures to pan out, it gave me the opportunity and displacement, and it ran to obvious levels of liquidity. It took out this short-term low. I wasn't interested in having any limit orders below that. This one here, I like that. And I have this one shaded orange here, okay? And what that means is I want to see it get below it. Each one of these candles hasn't really given me a kind of like a trade below it, spend some time below it, and then come back up and tap into it as a potential inversion fair value gap. If you're ever looking at my charts, if I'm sharing shaded areas on price, if it's shaded orange like this, to me, okay, my interest is some facet of seeing price go below it and come back up, and then treat it as a means of barrier that it doesn't want to get back above it. If I start watching candlesticks promote that idea, and then I see a displacement, I might invite the opportunity for them to put me into a short with a fair value gap, a institutional order flow entry drill, I don't know, maybe a bearish order block, something to that effect. But it hasn't given me enough information here to justify that yet. So I'm watching to see if they just take out this short-term high, and then what they do after that. If it was to take like this high out, or maybe come back up and even touch in this again. If it can get back below this one here, then I may entertain the idea of maybe trading that down below here. I do really like the idea that they've kept this low and this low in the kind of like in the rule book, if you will, that now we have relative equal lows there. And this one here has a lot of liquidity in it because we have, it's 5 a.m. It's during the close of the London session. So we see the market wanting to reach down into that, but then stop short of it, okay? And I'm quite certain that Phil, P-H-I-L, yeah, said no, not today, because ICT's got a limit order down there, and then came back for the stop. But who's Phil? So I'm interested in seeing, does it now want to go down below this area here, come back up, and then does it displace? It could do it, and it could do it so quickly and violently that it doesn't really give me a chance to get in it. But I want to talk about the importance of knowing when these high impact news drivers on the economic calendar, like we have a Monday. Okay, generally, I'm not a real big fan of Mondays. I like to see other traders go out there, put their neck on the block, and then see what the general consensus and sentiment is on a given week where we don't have non-farm payroll. Okay, so if we have non-farm payroll, I'm interested in trading on Mondays. Every single Monday that has non-farm payroll Friday, I'm trading and engaging on Mondays trading. I'm absolutely looking for moves to do, something that gets me into a trade. Generally, I'm not interested in Mondays otherwise. And because of that, I'm trying to counsel my son and his brothers, if they watch these videos too. I'm hoping it will inspire them to do it as well. But they shouldn't be trying to trade on a Monday in the morning session ahead of PPI and CPI numbers like we have here. So if there's ever a real big, huge neon sign that says, don't really try to trade on this, because I know a lot of my students will say, and a lot of people that don't like me, or they try to troll me for clicks and views and ad revenue or attention, they'll say ICT never trades, or he says never trade on Monday, and then they'll show their after the fact trade, and they'll say this is what I did, and that's great, well, kudos, but there's a lot of things I don't personally want to do as a trader, and other people do, and they make money. I'm not arguing that, but what I'm saying is because you're here watching my content, the interest is you're wanting to know my opinion or what I'm thinking or what makes me tick about an idea about the market going higher or lower. And what do I look for in terms of a trade idea? What do I look for a setup? Okay. Or when do I try to avoid taking those trades? It's important for my son to know that it's problematic on days like this because, number one, it's the morning session. Everybody's chomping at the bit to do something. And large pools of liquidity, big players in the marketplace are not going to position this morning because they know what's waiting on Tuesday and Wednesday. So because of that, just know that you're going to see a lot of this type of action where it's up, down. It's real skittish, meaning that it goes up, it goes back down, it goes back up, it goes back down, and it becomes very, very sloppy real quick. And it becomes almost seek and destroy like. Now, what is seek and destroy? Seek and destroy is where the market will go just above a short-term high, just to go back lower to take out a old short-term low, and then come back up, take out that short-term high that was just formed, and then vice versa. It'll go back and forth, and it kind of runs you over, even if you're in a position, as you saw here at the opening of the stream. Even though I can be right in the direction, and I can see where it wants to potentially go, here we are, it can still come back and take me out. Now, if it wasn't a Monday with the PPI and CPI numbers coming out on Tuesday and Wednesday, I would go back in and short up here. But because it's not conducive for that, because we have huge news coming out Tuesday and Wednesday, I know that the probabilities are likely. Didn't think I saw that coming, did you, Phil? The high being bumped there and then trading lower. Here is the new week opening gap high. So the bias, as I was teaching last week, here's your new week opening gap for this week. We had price above it. It rallied up. It took liquidity. And where's the draw going to be? Where's that like black hole of just constant tension and pressure to pull price? Caleb, it's the new week opening gaps. Okay. So if we have that, and we have an old new day opening gap here, we'll have a new one tonight when 5 p.m. comes, and then we have the opening at 6 p.m. We'll create another new day opening gap. But right now, we have to work with new week opening gap and old. Remember I told you last week that the new day opening gaps have a shelf life or life cycle. Not that it's limited to 5 days, but if you work with them in that perspective, you'll see how the market uses this idea where it gravitates back and forth towards these levels. They're inefficiencies that will be used again. They're like a magnet, will draw price to it. So when we're looking at bias, these are going to be your first central tenets to trying to derive what that bias is. So if we know that the new week opening gap is here for this past Sunday or yesterday evening, 6 p.m., in relationship to, I guess if I scrub over here, you'll see. Well, we'll come back to it in a second. It's less than 20 handles, so therefore I'm not really interested in annotating the quadrants inside of it. You can eyeball it. It's about halfway here, and the upper quadrants here, and lower quadrants there. And if it can trade through that, then we go back into new day opening gap of the 9th. Okay, so that's Friday's new day opening gap that would have been formed and calibrated from Thursday evening, New York local time. It's Thursday's 5 p.m. closing price and settlement, and then 6 p.m. 1 hour later, new session opening. So between those two price points, you get a here. And again, it's not annotating the quadrants or the midpoint because it's less than 20 handles. Okay, so if we have a previous new day opening gap below price, and we have new week opening gap here, and the market was made jagged here, and we have inefficiencies that we're respecting it, the market's going to do what at the opening bell? It's going to gravitate in the direction of these old inefficiencies because the market is algorithmic. So it has to refer back to those same things I was teaching last week. So that way we're not sitting here staring at book map charts, okay, or things like that and talking about nonsense. And the whole time the market's moving and not having had a trade or even knowing the bias. There you go. So you want to screenshot that, okay? You want to screenshot it again and put it on your calendar. The ICT was talking about this stuff last week and talked about it live, coming back up and just bumping this high here and then ripping it down. Here's your open, trades back up, touches the bottom of the inversion fair value gap. That's a trade, not on a day that's ahead of PPI and CPI. And the market rips lower, eats right on through all of the layered liquidity here, upper quadrant level, trades lower, and look at the bodies, how the bodies are stopping right new week opening gap. See that? Isn't that beautiful? So it's probably random. All this stuff probably is working off of, some classic Steve Nielsen chart pattern. Oh man, I can't help it. I have to do it. I have to do it. It's my burden. I have to carry it. So the idea of looking at bias, I gave you those elements last week, okay, and using them, fortifying that as part of your repertoire and your regimen, your guidance that I gave you last week. As you can see, all those rules are still here. They're still here, and we're trading down into the previous Friday or week of new day opening gap. Okay, so I know some of you may look at these ideas and think, well, this is pretty complicated. It's very hard for me to get a feel for what he's doing, and that's normal because you're getting exposed to it for the first time, and because you have TikTok mentality, you think it should be understood in 30 seconds, and it's not going to be like that. First of all, you have your brain clogged up with nonsense and things that other people sold you in books and courses and lied to you and said this is what the market does and this is how it works, and smart money concepts are nonsense and there's no algorithm. But here again, I told you last week, we're going to sit here and you're going to see this stuff working again. Here it is. Okay. But trading to the midpoint, okay, or consequent encroachment, that ends my interest in the morning session. It could come back up into this and then rotate one more time just to take that low out and trade the consequent encroachment. And that would complete my day or my morning session or the interest thereof. I would not be interested in trying to buy it. I would not be trying to go long. I would not be trying to go into a short that hopefully moves 200 handles or plus. That would completely be against my expectations. And why would I have that opinion about not doing much more or having an interest greater than I've outlined here, which would be consequent encroachment? Number one, it's already moved one-sided. It's had a really nice displacement lower. It just tore off, went a lot lower than most of you probably were expecting, but it went right to the levels I was showing you here in the live stream. It was going to draw to these levels because we've made a run higher during London. We rallied up, bumped a previous high, and then we had the market create jaggedness, as I was talking about. Okay, so there you go. It completely went down to the low. So I'm done. I would move to the sidelines, and everybody that's been following along and went short, take your profits and be content. Okay, I don't care if it goes lower. Just take your profits and move to the side. I know you guys are following this, and you're thinking he's got these levels on there, and I know it's going to fill. So I'm going to use my own methodology, and I'm going to trade to his levels. I don't want to hear about it. I don't want to hear about it. Please don't give me high fives in the comment section. Even though I'm the only one that can see that, don't do that. Because every single time I see a wave of people doing that and they're like, thank you so much. I took a trade on this and I used your level. Don't do that, because that means I'm going to be worrying about you. And I don't want to worry about none of you. Okay. But let's take a quick look real quick and recap what was going on. We have an old clean level over here, which very well could go up there and bump that. But we have to use the rules as I outlined last week, where you start looking at 7 o'clock and you're going to wait for relative equal highs. Okay, relative equal highs. Boom, boom. What's this high in relationship to that one? Is it higher to the high to the left of it or lower? It's lower. So doesn't that mean that meets the criteria, doesn't it? Yes. So when you have this or the candle at 7 o'clock, it just starts to drop down from there. I'm not interested in ever classifying that as the initial point of buy side liquidity. I'm not interested in that. I'll wait and defer my actions on annotating and labeling, because I know just to the left of that, it's here too. So I want to see it form literal relative equal highs. So in case you missed it, or I didn't give you a good enough explanation of what I meant earlier when we first started talking, it's in the rules I told you last week. So it's not like I'm ad-libbing here. It's what I said last week in the lectures. So you're going to wait So if your starting point is not 7 o'clock, okay, say it's not 7 o'clock and you start at 8 o'clock, right there, okay, the same thing. You're going to refer to any relative equal highs that have not been pierced or breached that formed after 7 o'clock, but sometimes they will already have taken them out. And then you'll have to sit and wait for your own relative equal highs or relative equal lows to form post 8 o'clock. If you're going to use the 9 o'clock hour, you have several other factors that you can use. Okay, the opening range, as I was showing Caleb last Friday. You all as students are familiar with this because I've shown this before using the regular trading hours. So if we were looking at it this way, are you mad, ICT, that they stopped you out before it dropped? No, because I know this is going to work again. It doesn't just work on one day. Okay, it works every day and every week, and it won't stop. So if we have, what's nice is I'll explain to you that they would probably run it to this fair value gap, maybe bump and clear the highs, and then drop it lower. So I can anticipate, and this is with experience, and this is also a little bit understanding the source code, what they'll do. If I'm going to be wrong, how will I be wrong? Now, for someone that may hear that and think, wait a minute, if you know you're going to be wrong, or you're potentially going to be wrong, like, that's not bragging rights. You know, if you know you're going to be wrong, why'd you take the trade? Well, there's going to be times where you get into a trade, and when you take that trade, it seems appropriate. And then the things that you were looking for start fizzling out, and they are no longer supporting your trade. So it becomes a much more likelihood that you're not going to get the objective you're seeking. And if it's something that you anticipate potentially closing the trade on you prematurely, wouldn't you want to move your stop loss in an advantageous location? So that way, if it was the reverse on you, you still go home with something, not a loss. That's the parts that comes from learning from me talking. When I'm talking about specific things, if you don't have a frame of reference to refer to the logic as to why is the trade still viable, why should I hold the trade, what prevents me from getting back into the trade if I get stopped out, there has to be rules for that. Okay, and if you don't start to build on them in the early stages of your development, you won't have anything to lean on except for your buying and being profitable, or you're selling and being profitable, and all the losses in between, and nothing except for the emotional response to that. Versus, these are the conditions. This is more appropriate for the chart to say this to me again later on, and I'm going to take that as a setup to get back into a trade idea that may still be viable. But if you are referring to the economic calendar and you understand the effects of manipulation that comes by way of PPI and CPI numbers, much like a non-farm payroll day and or FOMC, where it's highly influenced by direct manual intervention. I mean, you're not going to be able to be a part of the move most of the time because they're just going to steamroll over everything. But on a day ahead of those reports, and if it happens to be a Monday, you give yourself one chance. If you can get into a trade early on, wonderful, using the things I taught last week and what I'm showing you here. It's not random that the market's going to respect these levels, okay? I've said it ad nauseum when I first started talking about it last year on Twitter Spaces. When I introduced the idea of new week opening gaps and new day opening gaps, it was last spring, summertime in 2023. For the most part, I've watched most of the online chatter about them fizzle out. And frankly, that's exactly what I wanted to see happen. Because I shared it, and the students that have done any work in them, they have seen value in it. But because the majority of the online trading community, not just my community, but everyone, they're all looking for this magic lamp where they can pick it up, rub it 3 times, and a genie will pop out and say, what do you want to know today? Okay, the market's going to go up to this level. Buy it at this. You know, you got one more wish. You want to stop loss. It doesn't ever get stopped out. Okay, there's your 3 wishes for the day. Come back tomorrow. Rub me right, right? So I introduced the concept, and because it's too good it really is too good to be in the majority of everyone's hands. I allow the interest to fade, because if I keep pumping it, you'll start seeing the things that I just revealed last week. So because my son is interested and he wants to document it, I know that it'll hold your attention longer if you're seeing the logic that I'm going to explain, as I explained last week, and him using it, and then eventually seeing him go with Top Step, and then eventually pass his combine, and eventually get payouts. You'll see that the logic works not just in my hands and not just in other people's hands, but as a dad, I want to see him doing it in his own hands, and then have the rewards of being able to do it and repeating it. Doesn't need to happen every single day, Caleb, but overall, if you have a net positive month, because in the beginning, you're not going to have a net positive every single week, because there's going to be a lot of this that you're going to have hands off. Dad, he's got to do it and learn from it and trust that he's making the right decisions. And when he doesn't make the right decisions, you have to feel that effect and then work through that progress of, it didn't work in my hands. I did something wrong. Not the stuff doesn't work, that you did it wrong. And therefore, you have to grind through that. And that's, all of you are going to be the same way with this. I mean, you're all going to have those hit and miss. You're going to have days where it just works like a hot knife through butter. It just cuts through easily, goes right to where you want it to go right away, and you're done. You can go do whatever you want to do. Other days, you're going to have to really work for it. And I have learned over 30 plus years, the days that you really have to work for it, it's better for you to get out of the trade that you're in. If you're having a whole lot of mental capital spent on the outcome of the trade, and you're just worrying about it being right in your favor, it's actually a better exercise for you to develop discipline just to close the trade, turn the charts off, and go do something else. Because what you're doing is you're burning mental capital. You're worrying and stressing. And what you're doing also is you're triggering all of these stress hormones in your body. And I wore myself down as a young man doing that. If you spend every single day of the week, and for some of you, many hours each day, obsessing and worrying about what the market's going to do, and really not knowing what to do or how to behave when it does certain things, and signaling to you that, okay, it's done, be content with it. If you don't adopt those protocols, you're going to stress yourself out. And here's the thing, I have met tons of people that are profitable, but they're absolutely unhealthy and unhappy because they're constantly trying to get more than what they need. I've seen many people go out there and do exceedingly well intraday, and they go in again and they take another trade because it isn't good enough for them. They want to make more. And I'm trying to teach you to have a mindset where if you go out there and you do something once a day and you get the experience from it, if it's positive, wonderful. If it's not positive, now you have an opportunity to study what you didn't do right or what you didn't observe correctly. Those are the two perspectives to hold. Not that, this stuff doesn't work or they did it to you. Okay. I'll give you a perfect example. I knew there was a strong likelihood that these relative equal highs could be retraded to, because that the CPI and PPI numbers are coming out Tuesday and Wednesday. And the characteristic of this morning session ahead of those days tends to be a lot more of this type of stuff. Back and forth, back and forth, back and forth. And then bump, stop me. And I said, and then once it does that, good old Phil will take the price back down to where I said where it was going to go. And it did. So I can get mad like I did when I was 20 and say, oh, you so-and-sos, you did it to me again. Or I can say, you didn't beat me today. Even though you took away the majority of what I was trying to do, you didn't take everything from me. And that's the benefit of knowing where to take partials, because as soon as you take partials and you run your stop to a position of covering any costs, you are in the closest thing to nirvana as a trader, because now the outcome of the trade is no longer all that critical, is it? No, because you've taken something out of the trade. You've locked in a position where even if it were to come back on you, you can't lose. You can't lose, barring some crazy gap, that's always there. But you technically, barring some crazy volatility gap that would be unrealistic to expect. But I guess it could happen now with all the stuff that's going on over in Europe and the Middle East. To the Brits last year when I was talking about watch Britain, watch the UK, you're gonna have some crazy stuff happen. Are you paying attention? It's almost like reading price action, isn't it? So just be careful over there. And it's going to be coming here, and it's going to come to Canada, and we're all going to feel it. But the point is, you can react to those types of stimuli where you get stopped out prematurely and go back and hunt, try to do something extra because you didn't get your full run. If I pull this back up, this old high, those are the relative equal highs that the market was reaching for. But this is the level of least importance to me. What I want to see it do is trade above these highs here. Why? Because starting at time, 7 a.m., my interest is there. So we go up, we go down, we rally back above. So the buy side is taken, and just for good measure, it takes out the highs from the previous session. And then we break lower, and we have a fair value gap. Okay, and the market trades up into the fair value gap right there. And I'm looking at how the market wants to use old inefficiencies, because I'm thinking it's going to stay heavy and really work towards this low a lot faster, because it wants to do the moves generally a little earlier when we have big news on a Tuesday and Wednesday like we have in our academic calendar. When do you trade these early sessions, ICT? Why are you sometimes taking trades before 9:30 opening bell or before 10 o'clock's silver bullet? I've said this before, but this is the part where you write it down, okay? If I have an economic calendar that has like these big impactful events on the following trading day, then I'm going to try to take the trades early, because everybody's going to be in here trying to do something at the opening bell. And it's also a Monday. So because nobody blew up anything and we didn't go thermonuclear over in the Middle East, everybody wants to go in and take a lot of trades. So there's going to be a lot of volatility. There's going to be a lot of interest in trades right away. And I want to be in when the market's the cleanest. And how is that going to be determined? Well, what I taught you last week at 7 o'clock to 8 o'clock. I'm going to use that first 30 minutes post 7 a.m. and that's here. Okay, so here's 7 o'clock to 7:30 right there. Okay, so what did we form? That high, that low. That's why I'm delineating those levels. Okay, in case you have forgot last week's rules. So we traded down below it. Okay, so now we're going to wait and see. Does it want to come back up and upset these here? Knowing full well that the new week opening gap is down here for this week. August 11th, that's Sunday opening from Friday's closing settlement price. That's what the new week opening gap is. So since it's below it, and then the next new day opening gap is last Friday, the 9th, where is that? Down here. So all we're going to do for guidance, all we're going to do is follow the rules I gave you last week. We're going to wait for the market to be made jagged on the opposing side of where these inefficiencies are. Isn't that easy? All you're doing is waiting for them to run up, take out the smooth areas right here, and they ran through the previous highs, and then did what? We break lower, and then we have displacement in here. So if we go back through all this price action here, we can then start looking for, hang on one second, I thought I had my laptop plugged in. In case the acoustics are acting a little weird in the audio, it's because I'm inside the great room of my first floor of the house, so I have really, really high ceilings, and I can hear it as I'm talking. Sometimes it's like echoey. I'm in a big room here, so hang on one second. Let me plug this in before I lose the power. Speaking of power, last week we had the remnants of Hurricane Debbie come through, and the wind was kind of whipping up, so we lost power for a moment. until I had all my generators turned back on. Since I wanted to leave the session last week or last Friday at 10 o'clock, I had no interest in trying to log back in, and I had to take care of what I had to take care of. So I wasn't going on the site or the community post to try to tell you what was going on because I had things to take care of. But anyway, we had this inefficiency here, and going back over through all of this. See all this right here? All this inefficiency, even though we went back and forth through it here, I'm aiming for all that in there. And then we have this inefficiency. I traded into it there, right at the bottom, right there. You see that? I want to get in the trade. Some of you may see what I'm teaching and say, okay, I can see the fair value gaps. I can see the inversion fair value gaps he's talking about. I can see the order blocks. Okay, I can see it. But where do I get in it? Well, if I'm trying to trade and get short, I'm going to use the lowest probable resistance in terms of getting in the trade. In other words, I'm going to use the lowest threshold level on a fair value gap that I think is going to hold price down, because I have tried many times to be very, very, very precise with the stuff I understand and know what the market's likely to do, more times than it's not. And I've watched my limit orders. It prints the price that should have given me a fill, but it doesn't do it, and it runs the other direction. And to me, as a 20-year-old, that used to really make me angry, because it made me like, come on, this is like, I took it personal. I literally took it personal. And I'm assuming, like in this live stream, you have to assume that they're just simply not going to let you have it, especially if you're right a lot. If you're right a lot, you're standing out. There's going to be a lot of other people that's doing well, but they have an issue with just you. And I'm not saying you, I'm talking about me specifically. They can't stop all of you, but if they stop me, that discourages anybody from trying to follow me or the logic that I teach. See the difference? So take out the king. I'm not saying I'm the king, but take out the king and the pawns will fall. So if I share my stop loss orders, if I share my ideas of where I'm actually going to try to get into a trade, I'm actually creating liquidity and even a larger bullseye. So I try to do things in a manner where I don't want to draw too much attention to it, but you can see all of the logic is still here. But entering in the inefficiency over here, extending it through, what is it? What is this right here? What is that right there? This inefficiency, what is it? What kind of classification is that? Well, for folks that think they understand fair value gaps and whatnot, they think when it trades up there, it's going to sell off. Not if you don't have the information I'm teaching you. Because what are we expecting? We're expecting these relative equal highs to be taken in as much as these levels up here traded to. Go back and listen to the lectures last week. If you're watching this one and didn't watch the last week's lecture, or skipped or didn't really listen to any of the things I said, and you just watched and maybe were bored to death and turned off the thing because you think it's not of any interest, go back and really go through it and listen to it and take notes. Scout's over there snoring. You'll probably hear it. It is a reclaimed fair value gap. Meaning that, see, when the narrative and the time are not in an agreement, even though it trades back up to these inefficiencies, you're thinking just like everybody thought a down close candle. Every single time a down close candle's touched, the market's going to go up. That's what everybody over on Baby Pips thought when I was first teaching about the idea of my order block. And because they tried to do those types of things and assumed that, okay, it's going to go up, it's going to go down based on these candlesticks that ICT was talking about. And when they failed in their own hands, because they didn't understand the narrative, they didn't understand the logic and how to actually use them, they run away and say, well, it doesn't work. And then you have a lot of people that are doing that, and you have new people coming in and they have an interest and say, well, I hear a lot about this guy named ICT and these smart money concepts, and they start seeing other people's opinions. And because they're lazy, they'll take those opinions and say, well, they're saying they lost money, it doesn't work. So therefore, I'm going to avoid that because I don't want to be prudent and actually do the investigation myself and try to use it in my own hands and see if there's any valid used to this information. So therefore, that's why you get the stigma that's around me. But then for the people that actually go through the process of learning it, doing it the right way, and spending time in their own charts, weighing out the rules and things I've taught, I did give guidance. But the problem is, I've warned you ahead of time, it's going to take you a whole lot more time that you want it to take. And then when you start spending that time and you really make good use of that time, journaling and seeing the examples of what it looks like, you will see that the times that in your own hands that will fail, as long as you understand the correct narrative and you're understanding the elements of time, when these things should happen, you'll see that they work a lot more than they'll fail in your hands, meaning that there's an edge there. And with experience, you'll start saying, okay, well, if I see where it didn't work in my hands here, here, what was I doing those days or those instances that I was unaware of seeing when it was not likely to pan out for me? And then that's experience that I can't encapsulate in a book. I can't encapsulate that in a lecture. There are things that are going to be much more useful to you because I don't know where your shortcomings are in reading the information that's in Price. I don't know that. And you can tell me in an email, and I have lots of people try to do that. And they want me to fix their hang up. And I don't know all the things that you're feeling and what you're thinking, what you're fearful of, what you're excited about, what your motivation is. All of those things are going to be impactful for you either taking the trade or not taking the trade. And you're trying to rush through all those discoveries about yourself. And that's the undermining that's going to happen in your development. But you're going to fault something else or me or something else outside yourself is going to be the external factor for why you didn't find success. And to me, that's unfortunate because that's the prevailing mindset of most people today, old and young, because they're lazy. And I know you don't like hearing that. You think I'm being condescending, but it's the truth. Because you're not hearing me when I tell you you're going to have to do this for months, okay? Months. And you should be demoing, okay, for a minimum of 6 months before you ever trade with a real account, ever. Because you don't know enough about yourself. You don't know what these tools are going to do in your own hands. Some of you may have a wild run of just everything's working out good. And you don't have the lessons that come through hardship that are going to come eventually. And then you have to discover how to grind through that and refer back to when it was working in your hands. Don't throw the baby out with the bathwater. And that's what everybody wants to do. They want to find the next hot thing. I am the hot thing, okay, because this is the market. This is what the market's going to do every day, every week. The problem is there's going to be times where the deck is stacked. It's stacked. The deck is stacked mid-game against even me. That's manual intervention. In other words, you ever been to a casino? You ever been to a casino and you're playing blackjack and the dealer and you, maybe a couple other people are playing, and you just got a good hot run. And all of a sudden, you're making money, or someone at the table is making money, and then they'll come out and they'll change the shoe. Okay, the shoe is that little box they have multiple decks in. Okay, that deck or those decks, that is a stack. Okay, it's designed to run out a certain favor of odds in the house's hand, the casino's hand. Knowing how to count cards gives you an advantage. It doesn't tell you every order of that shoe of cards. It just gives you an advantage of how many cards are left in that shoe. But if they know, because they have the eye in the sky, that means there's people up there watching, there's cameras watching. If they know there's a man or a woman at a table that constantly is just cleaning up, they're going to come out and they're going to change the shoe. They're not running out of cards, but they're bringing a new shoe there, which messes up your count. If you're a card counter, if you're smart, you're getting up, you're cashing your chips, and you're going home. And you're going to go to another casino, and you won't come back to that one for months. Because now they're on to you, okay? These little things where it tells you in the marketplace that you are not likely to have the advantage right now. Something's been changed, okay? If you watch the movie The Matrix, when they see a deja vu moment, that means there's a glitch in the Matrix, right? Something has changed according to the script in that movie. Well, the same thing in price action. If you see something that upsets what is normal, are you going to go in and just say, I'm not going to pay attention to that? It's not a warning to me. I'm better than this. I'll overcome it. That's what I did when I was 20. Now, because I know I've been doing it a long time, I know how I can hurt myself. I can hurt myself in this. So to prevent myself from being overly emotional or too psychologically committed to the outcome, needing it to be in my favor for the sake of being right. These are all things I had to wrestle with. I had to create protocols and say, okay, where were my losing trades? Where were the times where I blew my account? Where were the things that caused me to go into a tailspin and I couldn't find the rhythm of getting back into finding a series of winning trades again? You find that by keeping a journal and being honest in it, but not beating yourself up. But it was easy for me to see where I was hurting myself, because when I was journaling initially as a 20-year-old, all of those journals were highly toxic and directed towards myself as a failure. So it'd be very easy for me to highlight what I was thinking. And most of it was relationship. And I didn't like where I was working at. And it's probably for some of you, that's the very central tenets of why you're overdoing it. You're pushing too hard because you want to get out of that uncomfortable state. This is the stuff that nobody wants to hear about, because it's a reminder that those things exist in your personal life too. And you're like, this has nothing to do. Like, I didn't ask to come and listen to Dr. Phil, okay? I want to hear how to trade. But you don't realize until you go through it that those are the things that are going to be impactful and resistance to you being successful, because you're going to tap into them subconsciously. And by having rules about knowing when I'm not going to trade again, I'm not going to go back in even if the market does this or that, because I know the economic calendar tomorrow and Tuesday and Wednesday have such a huge weight of volatility in the offing. It's going to happen tomorrow, guaranteed. We're going to have lots of movement on Tuesday, lots of movement on Wednesday. And a lot of folks are sitting back and they're going to wait for those reports. They're going to pass. And then they'll start putting money in the marketplace or taking money out in respect to whatever the market does as a response to those data points. But if you don't have rules and protocols in play that you know this is what you're trying to do and this is what you're trying to avoid, you're going to be aimless, like a sailboat out there without a rudder, wherever the wind blows you. And are you in control of your trading when it's like that? I can tell you, I was not in control of my trades when I was like that at all. And then I was always forced to have an emotional response that was always exaggerated. And when I was right, it was super skill. And when I was wrong, it was the end of the world. And I wanted to quit trading. I never wanted to do it again. And I had to convince myself by going back and look at the times where I did it right. And that encouraged me, because I didn't have an ICT talking to me. I didn't have these cheerleading sessions or guidance. Okay. I had a couple videos that I knew verbatim, and I couldn't get anything out of them anymore to keep me going. So I had to refer back to the times that I did it correctly. And then also treating my opportunities where I did it wrong as a means of, this is my goal to figure out what I was doing wrong there. Notice the language I used there. I didn't say how the market doesn't work and or the concepts don't work. I was being very personal about the opportunity of discovering where I was doing it wrong. And in my opinion, as a mentor, I see that a lot. I see it in older students that have not been profitable yet, and they have those tenets. They have those central tenets. They don't like to hear it because they want to be able to say, well, no, it's this and it's that. It's, you didn't teach me right, or you didn't teach me the secret this and secret that. Again, here I am on YouTube teaching the very things that are absolutely going to cause these markets to do what they're doing based on time and price. And it's happening again, just like every other lecture series I ever did, just like the paid mentorship videos I uploaded on the YouTube channel. That stuff doesn't fall out of favor. It's not going to get stale. It's what the market's going to do. But because you have so many things like a candy store in front of you, how are you going to use the information? I can't realistically force you into a mold, but I am in certain aspects, because he's my son. I'm leaning on the authority of being his dad when I say, you're going to trade the morning session, knowing full well that this will at least give him a baseline. And then if he wants to change up and go to trade in the London session or trading the afternoon session in the US, he can make that decision, because he'll have the same protocols that he uses here, just at a different time of day. And I'm not willing to make changes. I don't want to sit up in London. I don't want to do that all over again. I don't want to do that. So since this is, second time for him to go through this, it's dad saying, okay, I'm not willing to make changes to my schedule. I'll do it once to show you the logic. And for all of you that are here wanting to learn, and you have an interest in that time of day, but you'll see that nothing's really changing. It's just you're applying the same concepts of measuring time, determining where the liquidity is, and then waiting for this disruption. And the waters are made jagged or rough. Wherever it's smooth, okay, you're waiting for that jaggedness to come in. And if you look at what has been shown here, what I traded off of is these relative equal highs, this up close candle. I'm anticipating that as a bearish order block. Why? Because it's going above the relative equal highs. We had the market trade lower. It went beyond the opening price. Listen, folks, this is for order block fans, okay? My order block does not require to trade below the wick. If I understand the narrative, and let's talk a little bit about narrative. This morning, my interest was being short. I wanted to be short because we had a nice run all last week, and we really didn't see TGIF on Friday. I talked about it with Kayla. I said, I believe it could do it. It could potentially have a retracement as much as 20 to 30% of the weekly range. It didn't do that. They kept pressing it into Friday's close. Okay, wonderful. So how do I trade with that information knowing that TGIF did not form on a Friday? If the market didn't retrace 20 to 30% of previous week's range, and if it's an up close week, if I see that that's likely to happen, but it doesn't deliver, let's say I took a trade on Friday and I was trying to get short and it just didn't peter, it didn't pan out and it petered out and maybe it caused a losing trade, or maybe it didn't give me a fill, or it just didn't give me what I thought was going to happen. The end result is what was lacking. TGIF did not materialize and manifest itself on a Friday. Wonderful. So fast forward to Monday. If you're going to trade on Monday, and this is true even if there is CPI and PPI on Tuesday and Wednesday or later in the week, you can use this information. Anticipate the likelihood of 20 to 30% of the previous week's range occurring on Monday's trading. So it's TGIF, but the actual retracement of it is deferred to the following week. In this case, it's Monday. Do you need 20% of the previous week's range to be profitable? No. But it's one more little box to check that probabilities are better in the short than going long. So then when you start mapping out your day, 7 o'clock in the morning, as I outlined last week, determine what your initial high for buy side is and what your initial low is for your sell side. Wait for them to be taken. And if you have the weekly gap, the new week opening gap and the new day opening gaps are below price, and you have that function of determining, okay, well, it could retrace into some of previous week's range. You have a lot of things going in your favor that point to what? The initial run will offer you a range, so that way you can determine some kind of directional bias. That bias doesn't have to be the daily range bias where you're predicting the close is above or below the opening price. Remember, it's session bias too. And you need to be able to determine that first, Caleb. You need to be focusing on, in the morning session, I want to know where a run could form that is measurable. It's something that I'm able to participate in, and it's one-sided. Okay, wonderful. If you can see that we're above the new week opening gap and we have new day opening gaps below the market at 7 o'clock or 8 o'clock or 9 o'clock at the opening bell, then you know the weight of the market is going to be pressed to the downside. So the market's going to discover, probe into, discount arrays. That's something that's below the market price, and or seek inefficiencies that are deep retracements into previous week's range, or just taking out short-term lows that can be determined from a 15-minute time frame. Okay, so as the market was trading on this candlestick right here, we opened down here. after a down close candle that closed below the opening price of that up close candle. Let me zoom in. Make sure you can see. So this opening price, all I need to do is see price trade below that. And on the time frame, I'm seeing this candlestick, which is the 1 minute chart. That closing price right there validates this as a bearish order block. All I need to do is trade on an uptick. Well, the next candle will be open below that open price. So I already have that filter because it could have opened down here, or it could have opened above it. I want to see it open below this and then trade up. Where's my fill? See it at the opening price? Here's the opening. And there's where it's opening on this candle and trades up. I'm selling short when the market's going up. Okay. Stop loss goes to rejection block, which is the close on the order block. So we have a little bit of heat here, not much. What's it trading to? The initial buy side liquidity. That's these relative equal highs. Goes there too. So I know I can absorb a little bit of heat. It's going to come back and use this information back there because there is an algorithm. I know you don't like to hear it, but I'm going to prove it to you every day. And the market trades again lower. And then we have a gap in here. So again, as I teach, you're not using the wick of that candlestick right there. You're using the body's close. Why? Because it's different and there's a separation between the next candle's opening. So there's a volume imbalance there. So you have to incorporate that with your measurement of your gap. And then by doing that, you'll get a true consequent encroachment level, which is what you see all these candlesticks touching here. Right here. Now, truth be told, this is the part where you're going to, if you don't like me, or if you're looking for something to do the gotcha stuff, or, oh, he's lying here. I had Piper sitting to the left of me in my morning room, and I had my laptop on me. And I was trying to draw all this stuff on here. And then I had my cursor sitting right over here, just like that. And I was moving her. And her claws, which I have to trim them back on her front paws. I didn't get a chance to finish her last week when we were doing her paws. We got her back done, but she doesn't like to have it done. So I had to wait. Well, they were stabbing into me as she was pouncing on it because she don't want the other puppies to get near me. And I know this is probably boring you, but long story short, because I was pushing her away, I use a mouse pad, my laptop. Like, I don't have an external mouse. It's like a touchpad. I prefer them. I like them. I don't like external mouse. I don't like it. It's just the way it is. I have to use it, obviously, when I'm using my screens upstairs. But if I'm talking to you, if I'm executing or managing something on the laptop, I prefer it. I don't have a little mouse that's external. When I pushed her away, I ended up touching the pad and put me in there. And I had to deal with it. I had to accept it. And there's no logic in here that justifies that fill, except for I pushed the pad without wanting to do so. But the trade is still viable. I know that it's giving me the information I want to see, because look at the wicks here. It only goes above it by one tick. It only goes above it by one tick. Okay, wonderful. The bodies are proving to me that we're only really respecting the lower half of this gap. See that? Let me take the thing. I'll put it right back on in a second. Give me a moment. You see how the bodies are showing how it's just respecting the lower half. You want to see my PD arrays and my inefficiencies and fair value gaps, whether it be sell side imbalance, buy side inefficiency, or buy side imbalance, sell side inefficiency. You want to see half of them not respected, because that in itself is insight. That's how you know the algorithm is doing exactly what you want it to do. See, when I talk about signatures and price and what the algorithm is doing, the algorithm is doing this and when the algorithm is doing that, it sounds like bullshit if you don't want to believe there's an algorithm. But then when you start seeing me execute and it's the same logic repeating over and over again, or I'm calling individual candlesticks, then suddenly you're met with an argument that you have to contend with. I don't give two shits if you believe there's an algorithm. I'm enjoying the fact that I'm rubbing your nose in it. But there are times where these inefficiencies will come back entirely close in and still go lower. I do not like that. I don't like to see that in my trades. I don't like to see that in a trade that I'm waiting to see form. And for instance, say I'm trying to anticipate this as a return back up into it to go short, which is what I was wanting to do. I really wanted to execute as it hit this. That's what I wanted. I wanted consequent encouragement. I really wanted that fill. But because I'm allowing the dog, and I talked about this last week, when I don't let him up in my trading office, but I'm down here being with them. Otherwise, if she's not in the house, my wife, and we only have my youngest living with me and my nieces. So if they're not here with her, they're going to howl and cry, trying to get my attention. And that's going to be distracting. You'll hear them in the background. I won't be able to mute them because they're going to be howling because they want to be with me. Piper's the one that loves me the most, and she's trying to get on my lap. And I pushed the laptop and her away, and I did, and executed on it. I was like, oh, crap. So that's what that fill was in here. It was not me trying to get into a trade based on any kind of logic. It was just one of those things that happen in real life. Okay, it's going to happen to you, but when it does, what do? In the beginning, if you don't know these things, if you don't know how to trade and hold on to a trade or trust the logic, as soon as you realize you did something that you shouldn't have done, your best learning curve to experience is to close that trade and then see, all right, this is how I would still manage it. And what has it done? It completely disarms you. You don't have the weight of it has to be right. It has to pan out in your favor, because now you're stressing about, oh, I got into a trade where I partially pyramided another position size in this trade idea. And now I'm worried about this was a mistake versus watching what is price doing. Okay. So the signature is you want to see the upper half when you're looking at a CBI or a inversion fair value gap that should act as resistance, or if you are using a reclaimed fair value gap. That's a premium array. A premium array, you want to see the upper half of the inefficiencies or gaps. You want to see them leave that open. That's how you know the algorithm is respecting, number one, the PD array. And it's also telling you that you're going to see a measurable displacement in your favor. Now, right away, you should be getting this warm and fuzzy moment going over you right now, because that's the stuff that I never wanted to teach. That's the stuff that is not printing in price. So it's not in your candlestick. You want to see the things that are not in the candlesticks materialize. That means where there's an inefficiency, okay? How do I know when certain gaps are not going to fill? Oh, I go into every one that I'm referring to with a hope that they're not going to fill, because that's the algorithmic signature that I want to see in that. Now, if it goes up and trades to the top of it, then I need to see an immediate response and rejection there. And then it has to displace, and I won't touch it until it gives us another fair value gap on that time frame, or in this case, it's a 1 minute chart. It has to be 15 seconds, 30 seconds, something to that effect. And then I'll use a fair value gap on that time frame, because I've already missed the rejection, but I waited and looked for it at the top of the fair value gap. And once it starts to displace lower, then I'll just get into a lower time frame and get in sync with it, and it's fine. I ain't worried about it. That's the price delivery continuum theory that I was introducing last week. I don't need to be in the entries based on the time frames I'm studying. If I miss it, because sometimes I'm just being a little stubborn, and I'm trying to be very finessing about where I'm trying to get in at. I'm trying to impress either my son or some of you. Sometimes I won't get my fill, and then I have to go and use a lower time frame to get in sync with it. That's fine. It's very forgiving when you know what you're looking for. But that was what that was, okay? And then I have this inefficiency here, which also has this. What's this candlestick? What's this green candlestick right here? It is a bearish order block, just like that one. So this opening price, did this candle close below it once it passed through? Yep. So that validates that as a bearish order block. So if I can see price create these areas where there's an inefficiency, and then I can label the very specific change in the state of delivery, which is what the opening price is on every order block, then what I'll do is I'm watching. I'm not doing this physically. You should do it when you start studying price, with these things in mind. When price starts to trade back up into it, as it's trading into it, okay, I'm going to hammer that as a short. I'm not going to worry about if it fills me with slippage at the low of the gap. I'm trying to get inside of this order block between its opening price and its low. But I have to trade it as soon as it gets there the first time. I don't care how much heat and time I have once I get in it, because I know I have the framework of this right here, this gap, and the midpoint of this candlestick, which is what? Mean threshold. Some of you said consequent encroachment. Consequent encroachment is a gap. Okay, anytime there's a gap or inefficiency, the midpoint is consequent encroachment. If there's a specific range that's formed by the order block, singular candle, it's mean threshold. Okay, so the midpoint of that, essentially it's around here. Okay, so what is it doing? It goes right there. So it goes just outside of the fair value gap, but I'm referring to the midpoint of that gap. How do you know how to place your stop losses where they're at, ICT? When you put those stop losses in and you're putting it, and it looks like it's going to get real close to it, but it never goes there. It's this type of stuff behind me. I'm measuring all of the potential for the market to respect certain levels with this logic. And if it trades just to the top of the fair value gap, okay, what is it really reaching for? It's not that it has to go back to this. It's trading back to the order block because that's what starts this run lower. Notice that? So that takes us to the minor sell side liquidity here. Why is it a minor sell side? Because it's a low inside of this low to that high when I think it's going to go down here. And I'm aiming down here in this layered sell side liquidity. And if it's going to go there, how far could it go? It can go down to the new week opening gap. And if it expands through that, what's the next new day opening gap? It's August 9th. Down here. And as I told you, my interest in this is in the mid part of that. Would I, if I was still in the trade, would I have captured this low? No. And then trading down to this low, would I have held on further? No, I'm not interested. Because I understand what's forming. It's making the market jagged down here. It's enticing people. Keep selling short. It's going to keep dropping. No, it's not. It's done its work. And then it trades down to last Friday's new day opening gap, and then shows a willingness to want to go higher, and then trades right back over top of all this, and here's where we're at. Notice I'm no longer interested if it trades at that level here. Why? Because I have rules, I have protocols, I have understanding, and I know when to stop. I need to stop, pull the plug, and the market will still gyrate. Someone could very well be long in here. Great. Did you understand that the market was going to do the sell-off here? Did you participate in anything going short there? Are you mad about not catching that initial run? See, these are all things that you're going to have to learn how to cope with and replace it with, instead of toxic thinking like that, saying, okay, well, these are the things I've done correctly, and this is panning out for me. And I'm growing in my understanding, and I'm making progress. It may be monetary, and it may not be monetary initially. It may be just in your experience, gaining each day and the week that you do these things, the exercise and build in your understanding. Or it may be demo profits that you're going to use as a means to lean on. Because when you first start trading with real money, when you take losing trades, what reference do you have? If you haven't made a run of profitable trades, what experience do you have to lean on to encourage yourself? The demo trading, where you did it right. You need to find the sugar in it. Otherwise, it's going to be hard for you to stick with it. It's so easy to quit this industry. Very, very easy to quit it. There's so many things that's going to cause you to second guess yourself, doubt it. And just the work ethic that's required is going to keep most of you from ever becoming profitable. And it's not because you don't have a good mentor. It's not because you don't have concepts being taught to you that are useful. It's because you aren't ready. And that's really what it is. But anyway, the gravitational draw on price are based on the logic I gave you last week. So again, I tipped my hand to you last week on a grand level. Every single time I was on Twitter, every single time I am in other people's live streams and I'm pointing to specific levels, this is the logic I'm using. I said it last week. I'm saying it again here. I am trying to tell you with no uncertain terms that this is such a huge advantage. Some of you already know. I mean, you sent me emails and whatnot saying this is wild. This is really, like, I can see it now. Right. And that's how it should be. But you're still going to do it wrong eventually. And then you're going to get mad and you're going to try to do something to fix that one day problem, that one day error that you caused in your own hands. And then that's going to create a toxic response to you being responsive to an emotional or psychological impact of you doing it wrong. You don't want to go home with a losing trade. You're going to hurry up and try to fix it. Or you got a little bit of a drawdown. Or you got in a trade and you didn't take a partial, and then you're mad because you let it turn back on you and it's a small loss. Or the full loss because you didn't move a stop loss. And then it's going to cause you to want to do something to fix it. And my advice to you is don't. Go home with the loss. Realize it. Take it home. Sleep on it. And feel what it feels like. And you're going to find out, unless the Lord says no, the sun's going to come up tomorrow, the markets are going to be trading, and this stuff will still be in the charts. But something happens where we lose all rational thinking and we just go nuts. And they call it tilt, where you just completely just are out of your mind and you're just trying to do anything and you don't even know why you're getting in a trade. And all of a sudden, you cause severe drawdown or blow the account or lose the funded account or fail the combine. I see this so many times. So many individuals out there that are in other people's live streams are saying, oh, I just blew my account again. Or the live streamers themselves are blowing their accounts. And they're showing you new accounts that they just started up because they're not consistently holding on to the same ones. But there's people flocking to them, watching that. And their only real interest is they're going to give out a discounted affiliate link. Not that they can trade, not that they have any useful information coming out of their mouth. It's just give us a code. Give us a discount code. I'm not going to do that. I'm trying to give you how to do this on your own. So that way you don't have to watch anybody live stream it. And this is no knock against anybody else. But that's why I teach. I teach people to be their own independent thinker. But there's also going to be a big, huge crowd of new people going to watch other people doing it. I watch other people do it. I don't ever take a trade with another live streamer doing something that I think, wow, that's a good idea. I didn't see that coming. Let me join in and do their trade. I don't do that. I'm never doing that. I'm there looking for their crowd, their cheerleaders in the chat window. I want to see their response. And if it's diametrically opposed to the things I'm teaching you here, well, guess what that means? It's Candyland. It's literally like walking over to walking over to a baby and taking the candy out of its hand. I know they're going to cry. I know they're going to squeal and whine and say, you're a jerk, ICT. You called it right and I lost money. So now I'm going to troll you. I'm going to do this. I'm going to do that. And when they watch other people, they don't necessarily have to be my stuff, but other people that have the balls, the moxie to stand out there and tell the world what they're doing and trade and push the button in front of other people. I got a lot of respect for that. But they get trolled. They get trolled for doing something the people that are trolling them can't do or would never do. And they're miserable. But I love that because that proves that I'm going to get an emotional sentiment reading by that group of people. And when they have trolls in their comment section and other people are biting back at those trolls and they're saying the market's going to go here, the market's going to go, what did they do? They emotionally wagered. They've committed themselves. So I'm literally teaching you how I use other live streamers' chat window. And my point in telling you this is start looking at it when it does these types of things. When you start seeing it, okay, it's the perfect sentiment indicator. When people are showing you their hand and it's emotionally driven and it's a lot of emojis or it's very, very pointed language against someone or the market, they're telling you that they are completely letting go of the steering wheel, closing their eyes and flooring the gas pedal. And if they're saying that the market's going to go up and I'm anticipating it going down, and that criteria is there, and it's uncanny. They're doing that right when it's trading into a fair value gap, or it's trading right above a short-term high that should be upsetting buy stops. And they're bullish. I'm going long. I'm long now. I'm long 15 contracts. What are they telling you? They're traded with a funded account. They're not past the funded account yet, and they're trying to make it all in that one trade. Perfect. Perfect. That is the perfect scenario for ICT as a sentiment indicator, because now I'm going short. But everything I'm doing behind the scenes is what I've been teaching you last week. My son Caleb sits here and watches me do this, okay? And I'll say, it's going to do this, it's going to do that, it's going to hit this candle. And he's like, man, like it's literally doing everything right. I don't know why you're surprised. Your dad's ICT, right? And when I watch other people and they're just staring at the charts, they don't know what they're looking for. And they're talking and they're talking and they're talking when there's opportunities. There's really opportunities right there. And then when I'm in their chat and I say, note this buy side or note this sell side, I've literally told you where the market's going to go. And you can use any retail logic entry pattern after that to get in sync with it and write it up there or write it down there. That's what I'm doing. But what was I doing to come to those conclusions? What I taught last week and what you saw here today. Now, when I get stopped out, and you watch me get stopped out in profit, there was not a loss. It's just I wasn't able to stay on the trade the entire run. Do I go back in and rush and get mad, try to get back? No. I don't need to save face. I don't need to fix a problem. There's no problem. I understand that the mechanics on a day like today, ahead of CPI and PPI numbers, back-to-back Tuesday and Wednesday, it's a Monday. I didn't have TGIF deliver on Friday. Okay, then it's going to be deferred. It's going to retrace back into the range during Monday's trading, especially if we open up at 7 o'clock in the morning here and we punch above the marketplace to upset what? Relative equal highs here. Where was that formed? In London. So I know that it's probable that it's going to go up there. It doesn't need to. All it needed to do was trade above these relative equal highs because that's what formed after 7 o'clock in the morning. Just like I taught last week. The rules are not morphing. I'm not changing. I'm not cherry picking anything. Everything is the same thing every single day. And that's exactly what your trading has to be. If you're trying to change settings and you're optimizing bullshit because you're trying to look good in front of other people, if you're constantly optimizing, you have substandard bullshit. It's 7 o'clock, folks. 7 o'clock isn't changing when it's 7 o'clock. It does when you go to different time frames or time zones in the world. But I've already told everybody, calibrate everybody's calendar, everyone's clock, everyone's charts have to be ICT time. It's the same ICT time. It's the same ICT fucking channel. Everything's going to be the same thing every single day. You're not trying to reinvent the wheel. You're not trying to make it better. You're not trying to optimize. You're not trying to change settings. There's no fucking settings. Do you understand the value in that? At 7 o'clock, you're going to delineate that as a marking point. And then you're going to wait for relative equal highs and relative equal lows. Isn't that fucking delicious? Isn't that delicious? That it's not going to hide from you. They cannot hide it from you. How are they going to keep 7 o'clock from hiding? They're somehow going to hide 7 o'clock? Like you can't look at the fucking time on your watch that's set to New York local time. Like you're somehow going to just forget that 7 o'clock is on the front of the face of the clock. They can't hide that. Then what are you waiting for? You're waiting for relative equal highs and lows to form. And you're waiting for them to be breached. And here's the thing. If they have the market in a premium. Oh. You were talking about that in those mentorship videos, Michael. Could you peel back that onion a little bit more? Sure I can. Last week I told you, if we're in the time of day, 7 o'clock, 8 o'clock, and 9. In there, you're looking for relative equal highs to form. If we're above new week opening gap and clustering of new day opening gaps. All of last week's new day opening gaps, where are they in proximity to where we are here? Where are they? Where's price in relationship to this week's new week opening gap? At 7 o'clock. We're above it. The previous new week's opening gap, we're above it. So the algorithm is going to do what? It's going to seek fair value in a discount. So how can it mathematically and use time go back to a random fucking point unless it has a very specific reach to time, date, day of week, week of month, month of year, and where are these inefficiencies? When time of trading begins and ends. Oh my. Oh my, that's delicious, isn't it? My dogs like it. Hang on, I think it's probably Amazon. Give me 1 second here. I gotta tell you, I'll be honest with you, really. I enjoy these live streams because I don't have to go back and edit anything, and I'm really loving this new ICT where I'm not worried about, all the little quirky things that used to bother me. So anyway, when we have these signatures I outlined last week, and we start at predetermined times times of the day, which are what I gave you last week. We're measuring, we're waiting. What are you waiting for, ICT, at 7 o'clock? What are we looking for? Well, you're looking for a directional run, okay? And if we are starting at 7 o'clock here, and we have the new week opening gap for this particular week of trading, which forms on August 11th, Sunday's opening price relative to Friday's closing price. If we're above that, that's one checkbox that is likely to displace and move and deliver sell-side delivery. That means it's going to enter a sell program. It means it's going to drop. The price is going to have a sustained price run lower. It's further likely to occur if you have new day opening gaps clustering below where price starts at 7 o'clock. Well, you have your Friday new day opening gap and all the ones below it. And then you have last week's previous new week opening gap down here. See that? So it's likely to draw down into these levels. Wonderful. So now you have the first elements to building your understanding of bias. So you're not looking to go long. Even if the market springs higher and takes off and has a real huge dynamic price run, I'm not thinking, I'm probably wrong. I'm waiting for that to fizzle and run out, which is going to occur above old highs that formed after 7 o'clock. So I'm waiting for relative equal highs to form, and then I'm waiting for price to pierce above it. When that happens, I'm not afraid. I'm literally high on goofballs. I'm looking for the opportunity to see the price go below it, and it does right there. That validates that as a bearish order block. Not because it traded above London's high. That's not it. It's not, it ran stops above London's high. So now someone's going to call it the fucking, what they call it, the FU candle. It's an institutional candle. You fucking clowns. There's no such thing as an institutional candle. Okay, you fucking multi-level marketing motherfuckers. You liars, man. You're fucking liars. Come out here and call every fucking candle like I do. Do that. Then you'll prove that you have something. Hindsight, motherfuckers. Relative equal highs. Okay? It goes above that and then shows me, it proves to me that this change in the state of delivery, that opening price on that candle, I want to be at that price or between the low of that candle's wick on that candle. Anywhere near, that's my sweet spot. That's where I'm trying to trade. But my risk has to be defined as much as the midpoint or mean threshold of that order block. It does not need to be up here. Man, this is some good shit, ICT. Damn, this is good. Yes, I'm cooking out all week. Come back. I got some good shit coming. But that opening price, that's my entry on that candle. Oh, I don't have them up here, do I? Sorry. I'm sitting here acting like you can see the prices again. Here's the opening price, and that's the fill. Okay? That's the logic being used. And then in here, that's just human error, pushing the button. And I was looking at Piper thinking, man, you're messing up a perfect illustration today. But I love her anyway. And then the market trades with this fair value gap, and we have this order block as well. So the opening price on an up close candle, when the market is in a sell program, that means there's going to be sell side delivery. That means the market's going to be in a protracted delivery lower. It's moving lower. It's going down for a specific reason, for inefficiencies that are in a discount and or sell stops, which is sell side liquidity. So what does that mean? I want to be selling short when the market returns into any inefficiency or up at the butt end of an up close candle, because that's a bearish order block. Okay, so we have this candlestick right there. You see that? Look at that fill. What's it doing? I'm going to use the lowest threshold entry, the easy one, the one I know I'm going to get. I'm not going to worry about not getting it because of a limit order not filling. What is it? It's the low of that fair value gap on that CBI right there. Right here, this candlestick right there. Defined by this candlestick's high. I want to use that candlestick's high. I'm using that as my point of reference to get into the trade, knowing full well that this candlestick right here is a bearish order block. But I have to afford myself the likelihood of it touching this fair value gap again. Notice that? So am I going to adjust the stop loss because this fair value gap formed and I went in here and added more? Am I going to roll the stop loss aggressively because it's afforded me another entry? No. And when I add to it here, am I going to trade and aggressively lower my stop loss simply because I went into a trade? No. I have to then wait for the market to roll out of this after it's proven it's doing what I want it to do. The bodies are being kept at the high of that fair value gap right there, and essentially the midpoint of this order block, which is mean threshold. So first time hearing this, if you're a first time viewer, right away this is bullshit to you and you're going and looking for overbought, oversold indicators and moving averages. That's what you're looking for. You're looking for a signal service. And I want you to leave because I have no interest in dealing with people that are like that. I want to broom you quickly, okay? When I teach, I'm going to filter out the chaff, because if you really want to learn how to do this, you're taking notes, you're listening, and you're listening for logic that repeats, and you're going to fucking hear me say this ad nauseum. It's going to repeat a lot. You repeat yourself so much. Go fuck yourself, comment boy, because I'm teaching. I want to prove that what I'm doing is a repeating logic. It's a repeating logic that you have to have ingrained in your understanding and when you're watching price. Because if it's not part of your intellect, if it's not part of your vernacular, if it's not part of your daily technical vocabulary, then you're going to fucking fail, aren't you? But guess what? If I'm constantly bloviating on about how this is what it is, and this is what it isn't, this is what it is, and this is what it isn't, and it's never changing, it's never morphing into something new, then it's scientifically proven. 9 out of 10 doctors will fucking approve that ICT's got his shit together, and it's going to repeat. So therefore, you have no excuse not to be doing this stuff and observing it and logging it and looking for these signatures to be in price action. That's the experience that you're lacking. That's what overcomes the fear and the anxiety and the worrisome thoughts that you're thinking. You're thinking the algorithm is going to stop working because here I am, I'm teaching it live in front of everybody, and now more people are going to learn it, and they're going to change the algorithm. No, they're not. They're not, okay? They're not, because this is the science of how price is booked. So if this is what price is going to do, are they going to be able to change time? 7 o'clock ain't never going to come? No. It's always going to be there. London session is always going to be there. The New York sessions AM is going to be there. The PM session in New York is going to be there. And you saw last week how to deal with the Asian session if you want to trade that time of day. You may do it wrong, but they're not changing shit. Okay. So anyway, as I was watching price action, I mentioned how, because these were relatively equal, what is it? Those are relatively equal highs at 9 o'clock. If I had not taken a trade, say I was not in a trade, say I didn't have one, and I wasn't stopped out prematurely in gain, in profit. This is your 9 o'clock setup right here. Isn't that your relative equal highs? Isn't this price run from here up to there opposing where you think price may draw to? Where I was taking your attention here and I told you the new week opening gap last week, that's where it's going to draw to. Any clustering of new day opening gaps, that's your Friday new day opening gap. These are, the word escapes me, these are qualifying factors that put probability so far in your favor, and it was taught to you in advance last week, and the same logic is working here. Again, we're not trying to predict the closing price here, folks. We're just trading a session run. Something that's going to yield you something that is clear, it's one-sided, it's going to be very pronounced in price. It's not going to be something that, oh, it looks like it could have ran, but it's hard to tell there. No, it's definitely a run. It's definitely a protraction in price. It's one directional, and it goes to a level that can be predetermined. It's not random, okay? This type of lesson, I would have given anything if someone knew this and was willing to teach it to me when I was first starting, because I would be all over these charts, studying, annotating, and putting all these things in a journal every single day and adhering to these rules. And I would be so much better the trader in person, and I wouldn't have all the mental baggage I have that I put myself. It was self-inflicted. But you have all the advantages of having this information now and going forward studying it and learning how to better yourself and avoid all of the bullshit nonsense that's out here. There's so many things being told to you that this is what the market's going to do. This is what makes the market go up. This is a technique. This is a pattern. This is some horse shit. This is some algo. This is some kind of a indicator. Take the fucking indicators off your chart. Every single one of them. And if that makes you mad and you watch me, or if you like me and it offends you, get over it, man. Because you're literally lying to yourself when you're saying that that indicator has any bearing on what price is doing. It has absolutely fuck all to do with what price is going to do. It does nothing. It's literally doing nothing. It's calculating and compressing mathematically old moves that you can't do shit about. But what am I teaching you? This is the time when the market's going to run. This is how the move's set up. They engineer liquidity, then they run the liquidity. That's the manipulation. When you see that manipulation, guess what that means? The other side of the marketplace is now it. Tag, motherfucker, you're it. It's going to go the other direction. And some of you are still going to say this is complicated. It's not complicated. It literally is the easiest shit. There's nothing else that can be easier than this. Literally. I mean, how many times, again, every time this does this, I'm going to show you, again, how many times you need to see this before you start taking it serious and say, I'm going to start journaling and start looking for this stuff in old moves and collecting data. That way I'm building pseudo experience that will be used going forward when I walk test forward. Everything that's not realized in price delivery yet. That means you're walking forward with the hard right edge. You don't know what price is going to do next. So you're looking at the chart like this. You don't know what it's going to do. So what do you lean on? A lot of you just want to go to live streamers and just listen to what they're doing. And if they think it's going to go up, you wait for it to move 30 handles if they even hold a trade that long. And then once it starts doing it, it's usually the big bold green candle or bullish candle. Then you'll go in and buy it because it's got 5 more handles to run. And then it starts squeezing against you 17 handles and you get out. But then it goes right where you thought it was going to go. Or the live streamer hinted at but never took the trade to get there. And that's the cycle that I watch always panning out. It's crazy how this does it over and over and over again. But to break that cycle and to prevent yourself from going through those types of things, you have to have some kind of baseline. You have to have something that you're going to start doing and measuring. And then not only what is price doing when it's behaving a certain way, but how you feel. how you're feeling when the market does certain things. Do you get it real excited? When you get in front of the charts and you anticipate something happening and it starts moving in your favor, notice, are you getting really emotional and like adrenaline rush that you're right? And are you focused on the feeling of you being right at the moment? Because that's a problem. You cannot invite the warm and fuzzies until you close the idea. It means it goes to terminus, where you would no longer be in a trade. And you have stages of your development before you even get to that part, even with a demo. Like, we're just talking about the fundamentals of determining what price is going to do and why it should do it. That's the important, the why. I'm telling you when, I'm telling you how, but I'm telling you the why it's going to do it. That proves there's a fucking algorithm. Because if I'm pulling shit out of my ass, like some people like to go around the internet and pretend that's what it is, how is it that I'm sitting out here and I'm telling you beforehand where it's going to go? Look at the live streamers on YouTube. Predominantly, most of them, and I like lots of them, and I have an affinity for a few of them, but most of them, they don't know where price is going. They're reacting off of something that forms at a later time. They really don't know where it's driving to. And I've counseled one in particular to watch these lectures to help them. So while I'm not mentioning their name per se, they understand what I'm saying right now and who I'm talking to. If you start to implement these ideas, your trades will grow exponentially in terms of the yield, in terms of how much you're getting out of it. The precision elements will increase, and the comfort of you being in the trade and not being so skittish about, okay, I don't like this, I'm getting out. I rarely have that. In my 20s, I was a basket case. I'm watching Quotrek, watching charts go up and down just by price. And I didn't have charts. We just watched the data, the highest high and the lowest low, and where it's at right now. How many contracts are traded, and that's it. That's what you had. So because of that experience, I learned how to read the tape without knowing that that's what I was doing. And every time the high of the day would be breached, and then would back off on the bond market, or back off on British pound futures, or back off on silver contracts, or crude oil, or whatever I was trading at the time, live cattle, lean hogs. Whatever it was I was trading, I wasn't aware that I was learning how the market will constantly keep pressing into liquidity. I just felt that, okay, it's going to be a blast off move because we just broke the high of the day. No, not realizing that there could be deeper retracements around elements of time. Because anytime the market moved above a certain level, because I only wanted to be a buyer then, when I first started, I thought that now it broke out, it's going to keep going higher. And I would be frustrated that we would have retracements. And because I didn't know how far it would retrace, I didn't understand where the fair value gaps were when I first started doing this. I didn't understand where the buy side imbalance consequent encroachment would be. I didn't know where the short-term lows would be, that they would go down there to sweep them and then start running higher and create a new buy side imbalance, sell side efficiency. And that's the one that you want to try to go long in the upper half of it. And that's a model right there. I didn't know those things initially. I didn't have that understanding. I didn't have the insight, experience seeing it, executing on it. I didn't have that. These are all things I had to grow through, and through prayer and just helping, myself through personal counseling, which was, here I am. I'm swinging from one spectrum to the next. Imagine being the person that's going to coach you, but also tears yourself down, and you're the person also that just ran into the tree with that account, recklessly driving, the next trade before you should have taken it. Like, it was crazy. Like, it was literally insane. And how I arrived, if it wasn't God helping me, I would have never arrived at my understanding of how these markets do this. But I had to have some kind of foundation. And I'm providing that for all of you. And you're not entitled to it. Okay? I'm not obligated to tell this to you. But I just know that even when I'm done with this, whenever that end is, I don't know what it's going to be. But no matter what happens with Caleb, he could be wildly successful. You could be modestly successful. If he just gets half his monthly bills, I'm tickled to death by that. If he can just make his monthly expense of where he lives, all his bills paid, car insurance, all those things, he has to pay out of that, of his wages. I don't give him money for that. So that's a motivation for him to do better. And everything's expensive. But all of these foundational points here, this is my best for him. Okay? This is my best. I'm not holding back because you're all watching. I am proving to you that this shit is the real deal. It's the real thing. It's exactly what's going on in the marketplace. And I even told you this is exactly what I use when I'm in other people's live stream and I'm calling it. And many times it's against what they're saying. And it's not to be rude. It's just for me to go and say, hey, I support this live streamer. I've never talked bad about him. But I'm also there sharing. And I'm not doing it where, okay, well, they're long. I'm going to go short because I'm going to say, here's the sell side. I'm just saying, this is what I see. And the people that follow me and understand me, they know right away what I'm doing. Okay, he's saying that this is the sell side level he's talking about. So whatever the market's doing right now, he's going to be looking to go up into some kind of premium array. That means go through the time frames. Now you know, 15, 5, 1, go through it. And you'll see the fair value gaps, the inversion fair value gaps, the order blocks as I'm talking about here today. Reading price like this, Caleb, I'm not trying to sway your interest to an order block. I'm just showing you how when you're bearish and the market is in sell side delivery, that means it's in a sell program and it's going lower. Up close candles should be used as a means of staving off any advance higher. But not every up close candle is going to perform like that. It'll go back up into inefficiencies. It may touch the inefficiency again. Why? Because there's a measure of time that's afforded to it to do that. So if we know that at 9:30, that's like we're at the game now. This is it. It's the big game because the opening bell is in 30 minutes. So at 9:30, right here, right there, as soon as that bell opens, or sorry, as soon as the opening bell happens and the market's technically quote unquote open, it's been trading, but that's what they call the day session. What has it done? Well, at that moment, it's created these relative equal highs and has these relative equal highs and that gap right there, so it can return back into it. Now, I could have very easily moved my stop higher, but I don't do that because I'm committed to this is what I see in price. If it stops me out, I'll stop out with a gain. It's not taking things from me. It's just removing me off the bus before the bus goes where I was originally on the bus to go to, which is down in here, and down in here. I was showing you where the limit order was. I wanted to get out down here, but I was going to change that. And you've seen me do this. And I know when I talk like this, it's very easy for people with no character or just little dick energy boys. Okay, they'll say, oh, you're saying that in hindsight. I literally do this all the time. I show you what I'm interested in, but if it starts to really move, I'll take the limit order, expand it beyond, and then I'll start taking single partials off when it gets to levels I like. Just go watch my examples. This is on Twitter and on my YouTube channel. Like when I do those things, I'm using predominantly the logic I'm showing you here. Okay, so this is how you start learning how to read where price is going to go, because as I said on Baby Pips, that's your first lesson. You have to know where the market's going to go. If you don't do your initial work there, anything and everything that you do is wasted time. And I can't stress that enough, Caleb. If you try to do anything more than try to figure out where the market's going to gravitate to, and when you don't see it, like if it's not obvious based on what I'm showing just in last week's lecture and today, if you don't see that in price, don't hold an opinion. Don't try to form one, because the only thing you'll do is you're going to try to arm wrestle and develop your will. And it'll be many times contrarian. And I had to wrestle myself out of a contrarian perspective. I mean, there's certain times where I look for it to be beneficial for me as a trader. I let my personality, which is what I was talking about here, and every other time I talk about other people's live streams. The ones that have a live chat open and they allow other people to talk, I am diametrically opposed to the sentiment of whatever they're saying if the things I'm teaching are technically there in price at the time I'm looking for them. Those are my best trades. Those are the times where I'm absolutely in stunner mode. I got no problem going out in public and saying, this is where it's going. And look at the history. On Twitter, tens of thousands of you would be in my live stream or whatever Twitter space listening. And I'm calling every single individual 1 minute candle and where it went to. And then you watch my examples of recorded trades. And then I'm out here live streaming now, giving you the logic of how I do it. And it's still panning out. And you're still going to worry about there is no algorithm, or it's going to stop working, or I'm making up stuff. You're worried about all the wrong things instead of just learning how to do it yourself. You don't have to be a fan of me. I don't want fans. I want students that learn how to do this, and they tell me I've been able to take care of my family. I've been able to take care of my family, and I thank you so much for that. And I say in response, give praise to God. That's it. Because I want the invitation to redirect it right back to him. That's it. I don't want to be worshipped. I'm not the guru. I'm not the GOAT. I'm not the greatest of all time. But I don't ever want to move my stop open once I reduce it. And I'm content with getting stopped out. If I moved it too prematurely, I'm going to eat it. It is what it is. It's just, I'm going to live with it. And if it's conducive for me to enter again, and it's not today because we have big news tomorrow, and frankly, I'm not interested. And it's good for you to see me trade and see me get stopped out and still deliver where I said I was going to go, because that's going to happen to you. Do I sound regretful? No. Do I feel like I got to go out and try to save face? No. Because everything I'm teaching and taught last week is in your chart. It's happening every day, and they're not going to stop doing it because there's a whole lot of people out there, even listening to me. They're not going to do it. They're not going to do it, folks. They're not going to stick to the rules. They're never going to trade with real money because they're afraid. So there's no concern there either. They're never going to pass their funded account challenge because they don't have all the wherewithal to be personally responsible. They're going to overtrade. They're going to over leverage. Even understanding this, they're still going to break the rules. That's why I have students from 2016 that still aren't profitable. Not all of them are like that, but I do have students from my very first paid mentorship that can't find their way through this. And the ones that are honest, they've been very candid with me. They say, these are the same repeating things I keep doing and I can't stop. I can't help them. They have to make the decision. They know what those things are. So they have to figure out what those triggering mechanisms are that cause them to keep doing that repeated phenomenon that they know is going to give them an adverse response. It's not going to get them the results that they're looking for. So they keep doing it over and over again, expecting a different result. And that's where the frustration's coming from. And for an educator, it's very frustrating for me because I'm at the end of my ability to help them because now it's all in their hands. Clearly, the things I'm telling you are there in the charts. It's happening every single day. The problem is you're either not able to identify because you haven't spent enough time practicing and logging and then watching price deliver real time, looking for these things to repeat. Yes. If I was told that I had to do that at 20 years old again, that would have sucked. But after I blew a number of accounts, I would have been really interested in trying to do it. I know that because I have the tenacity to do it. That's in my makeup to do it. I didn't want to go into this and accept not knowing how to read price. I went in wanting to know everything about it. I wanted to know everything that was there for me to take advantage of, everybody else's perspective, and be superior to. That was my goal. I wasn't trying to be the best trader in the world. I wanted to be the guy that knew exactly what's going to happen. And for some of you, that just that can't happen. And there are days where I get it wrong, but that's my desire. That's always been my goal. And the way that these concepts, that I've had to create a language for so that you can see what it is that's behind the scenes that I can't teach you. These are the closest things that get me to that point. And truth be told, I am not satisfied with it, because I know there's some way that I could probably explain it differently, and it would open up your understanding a lot better based on what I've already shown that keeps repeating. But even knowing that, I don't know how to do that. It's very frustrating. So I had to, be content with what I've done, because I know I have students that do really, really well. And if it was something that wasn't really there, they wouldn't be doing well, would they? They wouldn't make money. They wouldn't have the accolades that they can prove, in front of the world that this is what they've learned. And now they put it to work and they're making money, lots of money. They don't work their job. They have their own little business now doing their thing. And to me, that's awesome. But you have to have some kind of personal responsibility going into this, and not just look for, well, it's going to be easy, or I'm just going to say he sucks and he's a fraud and this stuff doesn't work. Well, first of all, you can't say this stuff doesn't work, and you can't say that it isn't precise, and you can't say that it doesn't have the ability to call the market before it happens. I mean, look at these levels. Look how it behaves around these levels, and why it does what it does when it does it. See, these are all questions I asked myself initially as a 20-year-old. I'm like, I don't know why price did that when it did. I didn't see that move. There's no way. Stop. There's no way for me to determine that move starting when it started. Like, there's no way for me to have arrived at that. And then I would go in and say, okay, what was occurring then? What did price look like then? What did every one of these open, high, low, close bars, because that's what I was using back then, not candlesticks. My eyes were better than they are today. And I would stare at them and make annotations, and a lot of things that I thought initially were catalysts for why it did, I soon found out that they had nothing to do with it. And I would search indicators and see which one of the indicators would do a better job of determining that it was going to go up or go down. And I wasted so much time with all that stuff. And it really, I'm telling you, listen, sit still for a minute, okay? Because I'm about to close this video. I want you to spend the least amount of time learning how to do this. I really do. I want you to be able to do this and have no fear. I want you to be able to do this and know beyond a shadow of a doubt, even if you make a mistake today or tomorrow or the next day that you trade, that loss doesn't undermine your desire to do this and your confidence in trusting it. That's what I want for you. I love you, son, and I know that you can do this. I know you can. But you're going to have to sit down and go through this, and it's going to be daunting. It's going to feel like you're not learning anything. It's going to feel like it ain't clicking for you. But it's going to happen if you keep pressing into it. You'll see it. You'll be able to see exactly what Dad's telling you. It's going to do this and do that. We were doing it last, what was it, Sunday. We were watching it. What was it? Friday. When you see these things repeat, you'll be able to do the same thing Dad was doing. This candlestick's going to go right up here. It's going to stop right here. And then immediately that next candle or the candle right after that one on a 1 minute chart, you'll be able to determine the magnitude, the speed, and where it's going to run right to. And it's going to feel like a mutant superpower. And it gives you confidence. And in your age, because you're still in your 20s, you could potentially become an arrogant prick like I was. Because when you're 20 years old, you already think your shit doesn't stink, and you walk around and peacock about the smallest of little things. Because you want other people to recognize you and give you an attaboy. But it'll impress Dad more if you quell that and you just learn how to just be consistent and not be arrogant. Not be arrogant to your brothers if you get good at it. Because they're going to look at you and they're going to pattern themselves after what you're doing. And I want to see you learn how to do this well and not be arrogant and not try to talk down to anybody when you start making lots of money. I don't want to see that. I want to see you do well and be steady Eddie. You're not trying to be talking to anybody in a condescending tone, not to not to act like you're better than everybody else, because you're going to want to do that sometimes, and that's not going to be what people see in you, and they're not going to look at you and say, wow, look at that. The other 20-year-olds are going to want to be like you if you did that, because they feel the same impulse. They want to be significant, and they think acting like that will yield them significance or clout. And I'm trying to tell you, as a fuddy-duddy old guy, I did all that stuff, and I'm not proud of it. And if you find your way in success with this stuff, and you want to teach everything that you know that I'm holding back for you getting this foundation, if you want to give it to the world, that's entirely up to you. I won't say no, because once I give it to you, it's yours. But you have the ability to determine that. But if you're not properly rooted in decency and modesty and not being arrogant, you won't be prepared for it. I'll hold it back from you if you show those signatures and your character. But if you use this and you do well with it, and you show that you're not being arrogant or egotistical or just trying to be better than everybody else, believe me, you're going to try it, because it's going to feel like you arrived. It's going to feel like you are a superstar, and therefore you deserve to be treated as a celebrity. Don't try to be a celebrity. Make your money, live well, let everybody else think whatever they want to think about you. It doesn't change it, doesn't reduce it, doesn't increase it. But your concern about everybody else's opinion about you will be a personal reflection on you, and you'll care more about that stuff than just the things that you're supposed to be doing. Watching this thing just cascade lower and lower and lower. What a beautiful drop. Did something happen? I don't have any news wires in front of me because I'm just on my laptop, wondering if something just happened there. I mean, technically, we went back to the level I already outlined to you. Well, I said what I wanted to say today, and I showed you the logic working. You saw me get stopped out, knocking it out at like trailed stop loss. So it's not a loss. When I showed how all these concepts work, and I talk about how the market's going to behave, and it does it. On Twitter, I had always people asking me all the time, can you show a losing trade? Can you just do it wrong once in a while? And I'll be honest with you, the 20-year-old me loved seeing that. The 20-year-old in me loved reading comments like that. And I would snicker and I'd smile and I'd look at my wife or I'd look at my sons and say, look at this. And that was just me just nodding to the younger man in me saying, that's what you want to see all the time. But if I do it, if I show you, it's real, it's organic, like today. And I'm telling you when I'm interested in going back in and when I'm not. So what does it mean for tomorrow? And then I'm going to close it. Obviously, we have the 8:30 news drivers on Tuesday and Wednesday. They're going to absolutely be bonkers. It's going to be nuts. I'm not trying to predict the market ahead of that. You've seen on Twitter and wherever else I've tried to do it before. I've done live streams where I thought where it was going to go to, and it would go the other direction, which is fine because I'm not trying to trade ahead of the CPI. I'm not trying to trade ahead of the PPI number. They're face rippers. They're literally decapitate you if you're wrong, and it's unforgiving. So what we are doing is we're going to start our session at 9:15 tomorrow and on Wednesday and Thursday and Friday. So I'll give you my pre-market view. I'll go right into that. I'll talk about the levels. I'll have them on my charts. That way it's already done, and I can just point to them. Okay, I don't want to draw them out because it's a little too tedious. I did that last week so that we can see it, how it's done. But they'll already be on the chart populated. So then when the stream starts, I'll say, okay, good morning, whatever. And then point to, this is what I'm looking at. This is interesting to me. This is where my focus is. And I want to see if it does this or that. Then therefore, I would be looking for price to go here or there as a result of that. Okay, so the rest of the week, you'll see how I'm really looking at price and formulating an idea around bias maybe you talk about, how the market may behave in specific profiles. Not that you need to know how to do that right now, Caleb. It's not even really essential at all, really, because all you're looking for is a run from a stop hunt that is engineered based around time, then price, then it goes to an area of inefficiency, drawing to a new week opening gap and or a clustering of new day opening, or new week opening gap or a clustering of new day opening gaps. So it's this very, very bland, not sexy, not terribly exciting, rule-based idea of determining where the market's likely to go to and why. It's the same logic I taught you last week. It's the same general idea I taught when I was teaching liquidity, but I'm giving you a much more refined, right to the point, even though there's a whole lot of other stuff in here because I'm talking to my son, and if you don't like it, go fuck yourself. The idea is that you want to strip it down to the chrome. Where's it going? Why should it go there? And how can I know when it's going to start doing it? And what is the beginning of that move? Well, you're looking for the market to open up at your time when you're going to sit down in front of the charts. And if price is above new week opening gap, clustering of new day opening gaps, the market will tend to seek those old reference points. Then if you're going to be looking for it to go lower, you want to see relative equal highs form and then pierce them. And then once it rejects that, all you have to do is get on board with a fair value gap, institutional order flow entry drill, a bearish breaker, a bearish order block, a bearish mitigation block, inversion fair value gap that used to be viewed as maybe something that would have been bullish, but now once it trades below it, if it trades back up into it, see how fast it easily becomes usable. The language now suddenly means something instead of just talking like an ICT student or a SMT, SMC, Smart Money Concepts trader. You understand what that stuff means, not just using buzzwords. And then you know what you're looking for. And by having that understanding that repeats and that processes that you go through, following specific protocols, you'll learn by experience where your best setups for your personal risk and appetite for leveraging anything in here in terms of real money. There's no shortcuts to it, son. I promise you, if there was, I would be giving it to you and you'd already be using it. But this is the first part that everybody has to do. You have to do this part. And it's a sped up, advanced perspective on the things I've already taught, but this is the shortest route through it. There's nothing I can do to shorten this learning curve with what I'm showing you here. And for some of you that are listening from the outside and you think that this is too hard, too daunting for you, I am not the mentor for you. And it's okay. You don't have to, insult me on the way out. You just never have to come back here again. Don't waste your time. If what I'm showing you here doesn't resonate with you and you can't see this is what the market's doing and how it's behaving, don't watch anything from me. Don't even watch anybody else that talks about my stuff because they're not going to make it any easier for you. I promise you, they will not explain this. They had no understanding of what I gave last week at all. Zero. Not one of my paid mentorship students knew what I was teaching last week. You heard all the same terms, but you did not get it laid out like that ever by me. And none of them were teaching like that. So you're all in the same playing field right now. It's all been evenly distributed to all of you at the same time. Don't try to skip ahead and don't try to be better, faster than you should be. You're not even supposed to be taking trades right now. But the logic is it gravitating away from these things at the same time? Is it occurring at when we should see it happen? The backdrop behind the trade, when it went to this level here, piercing above just these little short-term highs after 7 o'clock formed. All that logic, that's the repeating phenomenons that you're going to get real comfortable with. And that means that you know what you're looking for. How many times have you spent looking at the chart thinking, damn, I wish my dad could just tell me how to read this easier. Like, it looks like a foreign language. Like I used to look at charts and it would just bleed together in the open, high, low, close bars. You ever stare and all of a sudden it goes to a blur and you like almost like a double vision, like you're crossing your eyes. I would be like that. 2 hours before going to work, and I have been up all night long, and I have to drive for a living back then. And it felt like a language I was never going to learn. I know what that feels like. But eventually, doing these things, you're going to start seeing it like sheet music. I know you know how to play an instrument, and you can read sheet music. To me, I don't know what the hell that is. Okay, just so you guys know, my son played the trombone in school when he was in marching band, and my oldest son Cody, he used to play the saxophone, and Cameron played the drums, and Caden didn't play any instruments, but they had the ability of reading sheet music, and I can't. Like, I cannot read it. I've tried. It just, I don't know what it is. It's something says, no, you are not going to pass. So I have an understanding what it's like for people when they see me talk about what price is going to do, and to the degree it does it. I understand. It seems like something you can't do, but I'm confident, son. I'm absolutely confident that everything I taught you last week and what's in this today, and the reinforcement ideas that I'm giving you here, that's all you need. And the rest is you just practicing it and studying it and collecting the information. I promise you, you will have the ability to do what you see me doing here. It doesn't mean you know how to buy and sell and pyramid on every entry. That's all that. That's not important. But being able to read where a price is going to go, that is your first mutant power. All of you listening, that's your first goal, to get good at that. Because everything after that point is easy. You'll anticipate fair value gaps when you're likely to see it go lower. Just simply wait for it to form on the chart. And that's what forward walk testing is. Walking forward, testing delivery of price where you're not pressing any buttons. You're just tape reading. You're going to watch them form and say, okay, it's going to drive up into that fair value gap. And then I want to see the upper half of it stay open. And then when it does, okay, now it's going to drop hard. And you keep doing this every single day, week after week, for months. And then what will happen is you get really comfortable with doing it. And then that's your invitation to start doing demo trades. But before you get consistently able to see what price is doing and anticipate the formation of the fair value gap, waiting for it to be there, and then anticipating it, trading up into it or down into it when it's going to go higher. Until you get to that point where you can anticipate that forming, you shouldn't even be thinking about a demo. You shouldn't even have a demo available to you. It should be just watching price, not worrying about nothing. And when it's boring and it keeps repeating, you have to get to that point when it's boring to you watching price action and you can see what it's doing, how it's behaving, it's measurable. It should not go past this point. Therefore, what you're saying is, without saying so with a demo account, is a stop loss just outside that boundary point should not be traded to. So the trade should still be open if you were in a demo or if you were in a live account. And you're teaching yourself and desensitizing yourself to the fluctuations. When you're looking at the chart without this information or not knowing how to trade with another methodology, I have to say this because I know when I say certain things like this, it sounds very condescending to, like, nobody else makes money but ICT traders. No. But if you're consistently making money, you're following something that you've spent time with. You know it intimately. These are the things that repeat. This is what it usually does. And I trust it, so therefore I'm willing to put risk behind it. When you get to this point of knowing how to anticipate the setups, that it's going to create relative equal highs because the new week opening gap and the new day opening gaps are below price at 7 o'clock. So I know at 7 o'clock, I'm waiting for a relative equal highs to form. Right away, contrast that with you not knowing what price is doing or anything. Nobody thinks like that except for our community. And it's something that we anticipate and we're sitting in there waiting for it to form. Guess what that gives you? Patience. It overcomes fear. It manages anxiety because you know what you're looking for. And you know why you're waiting for it, because if it can create relative equal highs, then you're going to wait for it to come back up to it and pierce it, and it does it there. And then from that point, you want to see every premium array. That means anything that ICT could use to get into a short idea, which one makes the most sense to you? And that's your initial model. That's the one you practice with. And it may morph into something different. It may be, it may not be fair value gaps for Caleb. He may end up becoming, an order block trader. It's something else, but I'm forcing him so that way he has a foundation, because I don't know how to address questions with him or direct him. And I don't have the ability and I don't have the time to do this for everybody. And I know some of you are sending me stuff and you're emailing me these long, really long emails. And I'm sure there's some really nice things being said in there, but you're asking me to have this one-on-one coaching type thing with you. I'm not doing that. So please don't be offended by it, but I have no time or interest in doing that. You're getting the best of the best because I'm sharing it with my son. And you're getting an experience that I had no interest in having with anybody else. So just be content with that. You clearly see it works. I mean, it works. I mean, you want this kind of stuff. You want to be able to see the things that supposedly the person you paid or bought a course from or a software package or whatever. If it doesn't work, you'll see right away it doesn't work. But on the other side of the coin is if it works and it works really, really well and its logic is so sound that it's scary. Like, this is information that the general populace, they don't think like this. The average traders don't think like this. And that's why it's hard for them to listen to someone like me. And yeah, I make it entertaining for myself to be the prick, the condescending prick when it's entertainment value only, because I know how to draw a crowd. That's the purpose of it. I want people to talk. I don't need to advertise, because if I say all the right things and push buttons, they'll talk. And then it calls people's attention to my channel. And then they'll come here and then I'm giving them that litmus test. See if it's real and see if it's not. If it doesn't work and appear in your charts, then it ain't real, right? And that means that you don't have to ever come back and do anything with me. But I love converting people. And I love it when they're coming at me as someone that is adversarial initially. And I have lots of students like that. It's much more satisfying doing that. If I can convert them and they came here to either insult me or try to say this, that, and the other thing, there's no algorithm, it doesn't work. And all of a sudden they're finding that it works. And they're like, dude, like this, I was there. I was just like the rest of you that talk shit about him. But I can't say that now because I'm making bread. I'm living on it now. I love that. That's how I scratch my ego. I get off on that. That really gets my rocks off. So it's an art at managing expectations, leading people enough to make them want to talk about me. And then that creates traffic. And I never had to advertise because I know how to instill an interest that will cause other people to draw other people to this channel. It's simple as that. And if I advertised, it would have been worse. It would have been really blown up. But I don't need to do that. But you'll get to this point where you know exactly what you're doing, when you're going to do it, and when you don't want to do it. And you're not going to have any regret when you do or don't, because you're content. Being content as a trader is such an elusive thing. And you think making lots of money should equate to being content, and it won't. It won't be like that. Lots of money being made doesn't make you content. Lots of money generally is a result of you chasing lots of money. Being content with making plenty and not needing to try to worry about other people's opinion of how well they hold an opinion of you, Caleb, is the wrong direction. There's lots of people out there that can't wait to see you be ICT 2.0. I'm looking for you to do the things I wish I could go back in time and not have done. And I wish I could change about me. I want to have that kind of impact on you in your development. I want you to be humble. When you make a lot of money, call no attention to it. Call no attention to it, because other people in their learning, they're going to be inspired by that. But there's a whole lot of other individuals that are going to see you and they're going to hate you because they're not going to learn it as fast as you might learn it. Or if you take longer, because it could happen, if you struggle a little bit longer than both of us think it's going to take for you to do this, that's going to be a reassurance to some of them. And they're going to be like, I'm glad that he didn't go right into this. Because if you take off and you start doing really well, invariably they're going to say it's me doing everything. And since you want to do this and share every aspect of it, they're going to see that it ain't me. When you share your feedback when we're doing our weekend reviews and we're talking about what your observations were and what you thought was going to happen and it didn't happen that way, I expect you to be really candid about it and say, look, this is what I thought, and it was, maybe discouraging. I want you initially to say where you thought it was going to happen and it happened, and I want you to share how it felt. And then we're going to move away from that happy, good, feel good, warm, fuzzy stuff, because that needs to be outside of your trading. The deep anxiety and fear and worry, that can't be part of it. And the elation of just being high and you can't do anything wrong, you got to keep that out of it too. But in the beginning, you want that more than anything, because that means it's successful. That means that you're doing everything right. And I'm telling you, it's normal for you to feel that, but you can't have that as a steady diet, because it will constantly be the goal. And that's not the goal. The goal is to be indifferent. When you can get up and say, I know I can go out there and find the next move. I know I can participate in it, but I don't have to. But I'm choosing to sit down in front of price because this is what I anticipate it doing, because this is what my back testing, my journaling, my dad's taught me, and it works like Swiss timepiece precision. And I have to get myself acclimated to that precision and develop a synchronicity to that precision, because you are not going to beat the market ever, son. That's never going to happen. The only thing you can aspire to do is get in sync with it. You're not beating the market maker. You're not beating dad, okay? You're just getting in sync with the market. And that's all you need. You just need pieces of the week, from Sunday's open to Friday's close, where everything is just right for you. Then sit down, follow the rules dad's teaching, engage with it, and when it gives you what you're looking for, be content, turn the charts off. That's exactly what I'm looking for. If you do that, son, I will be the happiest, most proudest dad I've ever been, because I know that that will yield the interest with your brothers. And then what are they going to do? They're going to try to pattern themselves off of you. And that will send me over the moon. I'm not expecting you to be an Olympic feat trader. I'm not expecting you to do any crazy town stuff. I just want you to do just enough. And you'll see, as soon as you start making what you make at your job, and how fast it can be done over the course of a week with very little effort, then your mind will shift to thinking, wow, if I'm only doing this much and I'm not emotionally driven to do more, what happens when I allow money management to do all the heavy lifting? And then your account starts to parlay and parlay and parlay, and you're not doing any more effort than you did when you developed your own model. You're not doing any more heavy lifting. You're just doing the same minuscule amount, but the management of your money and the equity that it supports will do all the heavy lifting. And you're never doing any more in terms of greater than 1% risk. You're never going to assume a trade that has more than 1% risk. You're not going to try to trade every session. You're not trying to trade more than one time a day. And if you take a loss, you're done. And that's your model. It's not, I'm going to go back and make it. You're done. Those were the things I should have done when I was 20. If I would have done that, my life would be so much better if I would have done that, instead of trying to be Mr. Wonderful, Mr. Everything. I put myself through stuff and caused all kinds of mental scar tissue, chasing perfection, chasing more money, trying to outdo everybody else when I had enough. I had enough to do exceptionally well and never need to do anything else. But I kept tinkering and tinkering and tinkering. And then I took away from the real reasons why I was wanting to trade, because I wanted to live comfortably. I didn't want anybody telling me when I had to go to work, when I can take a vacation and whatnot. And you're feeling that right now. When mom and dad just say, well, we're out of here, we're getting up, either get on the road and get on with the RV, or if we just rent a car, because I don't drive my personal car when I go away. We can do that anytime we want. And that's one of the things that my kids tell me all the time. I want to live like you, Dad. Okay, this is how you can get there. But it isn't going to be fast. It isn't going to be easy in the beginning. But once you understand these rules, once you understand what it is that you're trying to replicate every time you do this, you're going to see it's the same stuff. And some days you'll think you see it a certain way and it won't pan out that way. And the outcome will be adverse. It won't be a good thing. But it doesn't mean it changes anything. It doesn't mean no longer works or you're not going to be successful. It just means, okay, stop. If you have one bad result and you're limited to only one exposure to the outcome, good or bad for that day, and you stop, you can't be mad. You never are going to have an anxiety attack. You're never going to be panicked about getting it back right away because this is the normal procedure. If I take a losing trade, I have to stop. That prevents you from going into tilt. That prevents you from getting greedy. It prevents you from being fearful of not knowing what to do because you feel like you got to get it back and you try it again, you lost again. Now you made a little loss, now bigger. You'll never want to overtrade. You'll never need to over leverage. It becomes your job. When you go to work, you're not trying to do more than what your supervisor is asking you to do. Nobody does. Nobody works like that. And your trading needs to be the same way. You need to simply just look at it and say, well, this is what I expect the market's going to do. And I see this potentially being there as a setup. And if I take it and I lose, okay, no problem. I'm going to turn the computer off. I'm not going to give myself any toxic fuel to just worry myself into anxiety or grief about it. And I'll try it again tomorrow. I'll log it tonight when the market's done. And it's over. It's it. It's painless. It's literally painless. That's a systematic approach of controlling fear and greed. But I have a lot of students that hear me say that, and they know that that would work, and that would have worked for them if they could stick to it. The problem is social media invites it. ICT live streaming now invites more of an interest in doing stuff. And it's hard to say, I'm not going to look at the charts or trade anymore, especially if you have a losing trade, because you feel like you got to fix it. And you don't need to fix it. You need to feel what it feels like to go home with it. And then over a course of a month and see how that 1 or 2 or maybe 5 losing trades over the course of a month has absolutely no real effect on what you're doing and what direction you're going. But you can't appreciate that just because I said it. Like anything else, when you were growing up, if I told you don't do this, you were the first one out of all the kids. Well, Dad said not to do it. As soon as Dad turns around, I'm gonna do that. So I know it's an inherent nature in anyone, but of all my kids, you've had that in you. So I'm telling you, this is the best way that you should go about it, and it's for your benefit to do it. And as a default, I would be very, very proud if you are able to do it this way, because that means you're going to be better than me. And I really want that, son. I want you to be better than me in every aspect. And if you listen to me, you will be. And I can't wait to see it. But that's it for this one. I'm going to close it, and I guess we'll be back at it again tomorrow at 9:15, Lord willing. And until I talk to you then, be safe.